Afternoon, everybody. This is Sherry. I'm your host for today's Traders Exclusive Strategy Series. We've got 4 top traders with us today, and they are going to talk about how you can transform risk mitigation with asymmetric setups, get a top analyst to analyze your pet markets for you, identify markets that are about to make a huge move, and spot key reversal areas, just to name the tip of the iceberg for you. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. This is also where you're going to find the recording of today's webinar. And before we get started, I have to share a quick disclaimer. You should carefully consider, basically it says you should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. This is an educational seminar. Please do take notes and hold your questions to the end. Have a little context with it so that we know exactly where you were in the presentation. And I'd like to introduce to you our first speaker, who is Ernie Varitimos. Ernie, you're gonna have to fix me with that. He's with Asymmetric Advisor, and he is the former chief architect for Sun Micro, quant and hedge fund manager, semi-retired for the past several years, active in the market. He's also an online biz owner. Welcome, Ernie. I'm so glad you could make it here with us today. And I'm going to turn the microphone over to you.
Great, thank you, Sherry.
There we go.
It's great to be here. Thanks for inviting me. I really appreciate it.
I'm glad you could make it.
All right, so I'll just get started then. Thank you for the introduction. I won't go too much into that. I just want to say I've got about 40 years in the industry in both technology and finance. And so I've been doing this for a long time. I currently run a service, and the strategy I run in there is what I'm going to use as sort of my demonstration for the point that I'm trying to make today. And that is all about using asymmetric strategies to mitigate your risk. And let me just start by saying that, like most traders, I've been in the game for a long time, and I've had my failures and I've had my successes, and it was a roller coaster ride going up and down, up and down. I tried everything, and there were times where I was high flying, running a hedge fund, trading tens of millions of dollars, and other times where I was down in the dumps where, you know, I was trading my own account and losing hundreds of thousands, and everything in between. So I guess that I'm a seasoned professional in both winning and losing. And it took me a long time before I started to realize what worked for me and what didn't. And what really opened me up was when I took on some mentors, and I had some really, really impressive mentors too. So I was very fortunate that way, and meeting them, and the fact that they would even spend any time with me. And they opened my eyes up on what trading was really all about. And one of my mentors, he used to say that trading is the hardest way to make easy money. And what he was saying there was that the upfront work, finding an edge, and then developing the discipline and executing on that edge is really what it's all about. Most people never really find the edge. They think they have an edge, but they don't. And I came to realize that from a retail trader's perspective, there are very, very few things that have real edge, and most of them are elusive. You start using technical analysis and price action, and you see people that are gurus and they're successful, and they convince you that you can use their strategy, and you try, and you might have some success, and then failure, success, failure. It's a never-ending cycle. What I found was that there are really only 2 things that have real definitive edge in the markets. And both of them are exercised by professional traders. Now, the really weird thing about this is that being in the market for so long, when I was with Sun back in the 2000s, my primary customer was Wall Street. As a matter of fact, my team literally built the systems on Wall Street, including the exchanges and all the investment banks. And so I dealt with these people all the time. Yet I never really understood what made them successful compared to, say, the average Joe retail trader, which I was at the time, even though I had access to all these people. And it took me many years of up and down work to really figure that out, and not until I had the mentors to sort of open my eyes, you know. Anyways, what I found was that there are really two ways that you can win in this market. One is that you can either have an arbitrage, and what an arbitrage is, that is where you can play both sides of the market and you have a guaranteed win. And market makers are a good example of this. There are also arbitrages that you can find out in the world, you know, where you may be in two different markets trading the exact same thing, and they may have mispriced that asset, and there's a difference. And if you're in both markets, then you can go long the underperforming and short the overperforming, and you make the difference. And those are fleeting things, because the market, like they say, is efficient, and so those types of arbitrages close up very quickly. But as a market maker, that is your job, is to work an arbitrage, and you automatically get the spread. So it's like guaranteed money. There are also other arbitrages that are out there in sports betting, for instance, and a lot of people don't realize this. And there are services that will help you out with this, but there are bookies all over the world, and they're all making and laying odds on the same events, but they're not all synced up with each other. They all have their own ideas. So you could literally do an arbitrage between bookies and find some that are overpricing and some that are underpricing, and make basically what is free money on what is, I think, mostly illegal in a lot of places, but you can actually find services that will provide that for you. Anyways, arbitrage, that's one way that you can make money. The other way you can make money that has really a definitive edge, and that is in options, but not any options. You've probably seen a lot of the literature, and people talk about how buying options is kind of a losing proposition. It's really against you. I mean, most people and most long options expire worthless. And the people who are really making money in the options game are those people who are net sellers of premium. So let me back up a little bit and explain what premium is. So with options, they are contracts on some underlying asset where you are betting on whether or not that asset will go up or down, and you can use either calls or puts as your option type to do that, and respectively. And when you buy an option, you get the price of the option, which is the intrinsic value, or the difference between what price that you're trying to go above or below, and then some extrinsic value, which is a time and volatility value that is a premium on top of that option. So as a buyer, when you are buying something, you pay for that thing, that options contract that you're betting, plus you get the premium, and that's an extra cost. It's a lot like if you're buying things like silver coins, or from a dealer, you buy the spot price plus the premium. It's the same thing in options. You're buying the intrinsic value of that option plus the premium. There are some options that you can buy where the intrinsic value is what they call out of the money. There's no intrinsic value because there's no overlap between the strike price that you chose and the actual underlying. And so now the value of that option is all extrinsic value. All time and volatility are the two things that really work into the price of that option. So as a buyer, when you buy something, that premium, that extrinsic value of that premium, is slowly decaying for the life of that option. And like all contracts, options have a period of use, and they expire on a certain date. And that premium is slowly decaying until you get to the end of that date, or the expiration date, until that extrinsic premium, the time value and the volatility, is completely gone. Now, that's value from the buyer of the option. And so that means that their extrinsic value, as they hold that option for a period of time, is slowly decreasing. And the value of their option is actually becoming less and less, unless the intrinsic part is going in their direction. And so it's a race of time for people who buy long options. They have to make sure that their idea is better and works out faster than that premium decays. Because if it doesn't, they could end up actually losing money. And there are even cases where the premium, the extrinsic premium, can be so much that even if price goes in your favor, in your direction, that you could still lose money because the value of that option could shrink so fast that you're underwater. And that may not make sense to a lot of people. You think, well, like a stock, if I choose to go long on a stock and it goes up, I make money. If I choose to go short and it goes down, I make money. Why does that happen in an option? It's because you have these two different parts to the option, the intrinsic and the extrinsic. And if there's no intrinsic and if it's all extrinsic, then you're completely beholden to what happens to that option based on that premium, right? So as a long or buyer of options, you don't really have any edge. As a matter of fact, you have almost a negative edge. It's like going to the casino and playing the roulette table and thinking that you have an edge, right? That if you put on enough things, but there's an equal number of red and black, and then there's that 100 there that isn't anything, and that's all in the casino's favor. That's their premium, because they know a certain number of times it's going to land on there, and nobody wins but the casino. So again, if you're a long buyer or a buyer of options, you don't have edge. You don't have edge like the person who's doing arbitrage. They have a guaranteed edge. But as a seller of options, you're the person on the other side of that equation. The seller of options actually gets that premium as almost like as a fee for giving that person who's buying giving that person that's buying the option their right to use that. And if that buyer of the option, their thing works out, then the seller is obligated to give them their profit. But let's say that none of that happens, and we know that most of these long options are expiring worthless. Then where does all that premium go? Well, it goes into the pockets of the person who's selling the option. So selling premium actually has some edge, but there's an additional edge that a lot of people don't realize, that the pricing of an option, the pricing of that premium, not only is there time, but there's also volatility, or what they call implied volatility, or the future expectation of what volatility might be out there. And there's an interesting thing that happens with volatility, is that it is routinely overstated. In other words, things that are in the future, because us as humans, we're not these perfect animals that can really deal with things that are in the future. It kind of gives us the heebie-jeebies. We tend to overstate or exaggerate how bad things could be because we don't know anything about them. It's an unknown. And so this overstatement of premium, it happens the same way in the markets. This overstatement of premium, it represents an overpricing of the extrinsic value of those options. Hopefully you're all with me on this. But it's a lot like if you were a vendor selling a product and you got to overprice everything and everybody would buy it and you're happy, right? So as a seller of option, you're happy there too, because that premium is overpriced. And it's not significant, but it's enough, just like the casino, to have an edge, and a pretty significant edge. And it's like that about 84% of the time during the year. There is a small period of time where you don't have that edge, or at least that portion of the edge. You still have the edge of being the seller of an option and collecting the premium because time is on your side. But you have this additional thing that nobody else has, and that is this overpricing of the option. So you get a little bit of a bonus on top of everything. And as the option comes closer and closer to expiration, that gap between the overstatement and what the actual volatility is closes. And so that is really one of your edges. So all of that is good. That's great. But still, people find a way or manage to find a way to lose money. And that's the interesting part. That people who are entering the trading profession, they do just about everything that you could do to figure out a way to lose money. Even if you gave them perfect trades, perfect setups, people will find a way to screw it up. I don't know. I don't understand what it is. It's not like the Helsinki complex or something, but there is something, some sort of self-destructive thing. Maybe we carry baggage, or it could be the fears that people talk about, greed and avarice and opportunity and FOMO. It could be all of those things. But a lot of it is because I think that we're fallible beings, and we do not work well when people tell us, hey, you got to do it this way. And it takes a long time before you can sort of realize and comport to another way of doing things before you start realizing, oh, that is the way you do it. A lot of it comes down to confidence. And until you have the confidence that something works, you're skeptical, and you're the type of person, or most people are the type of people that will want to challenge those ideas. And so even if you're given something that seems okay, but let's see if it works out, you'll say. And then at the first chance or the first indication that it looks like maybe it's not going to work out, you bail, or you try something different instead of sticking with it. That's because you don't have any confidence in what maybe there is an edge in that strategy somebody has presented you. So that is why, there was this parable of this, the best trader in the world, and then you put a failed trader next to him because they're at a prop firm and they wanted to make sure that this trader could maybe get out of his slump or whatever it is that he's in. He just can't seem to win. So they took the best trader in the world, who happens to be in that prop firm. They sat him next to each other, and all this guy had to do was copy what the best trader in the world does. So they go on, and the best trader in the world's making all kinds of gobs of money, and the other guy, he's trying to copy his trades, but he ends up losing money because he makes bad decisions, second guesses things, gets out when he should be getting in, bails too early, overcommits when he thinks that, man, now I can start piling in, and ends up losing. It is just a that is the nature of most of us, quite frankly. Now, what made that best trader of the world the best? And that is, he has the confidence in his strategy. It's not that he has some sort of magic touch, although there are people like that. There are people that seem to have that Midas touch. No, it's because he knows what his edge is, and he exploits it. He exploits it to the nth degree, and he knows all the ins and outs. He knows all the pitfalls. He knows how to react. And those cases where he doesn't know, he has a process for dealing with that. On top of that, that same trader knows how to learn from his mistakes. So he puts himself in this kind of continuous improvement process, what some people might call Kaizen, where he plans all his trades out, he executes the plan, he reviews everything that he did, whether he won or lost, looks at what he did right, what he did wrong, and everything in between, and what he could make of that to circle back to the next trade and input that in as a new modification to the way he plans out his trade. That's a continuous improvement loop. That's what somebody who has real confidence does as a matter of course. They don't even think about it. It's second nature. And that's really what it takes to be a successful trader. You need to have that kind of mindset, that kind of confidence, no matter what the strategy is. And I know that everything that I'm telling you has nothing to do with asymmetry, right? But it does, because even with an asymmetric trade where all the odds are in your favor, you can still figure out a way to screw it up, and you will. I know, because I know people in my service where I give great trades and they fight you every step of the way and they figure out a way to screw it up. And it's usually the people that are seasoned traders that are coming into the service. They are the worst. And I don't know if you guys, if you're a seasoned trader or not, and you have your own ideas on the way things should work. And if someone presents you with a new strategy, if you can open yourself up to it and just accept it, and then for what it is and be objective and go that way, and then build up the muscle memory, that's great. But quite frankly, 95% of you are not that way. 95% of seasoned traders. That's why that 90, 95, some studies have shown that 98% of day traders lose money. 98%. That's crazy. Conversely, what I found is the person who comes in with absolutely no experience, maybe they've done a little bit of investing, they have some mutual funds or something like that. They're the easiest people to teach the strategy because they have no baggage. They have nothing in the way of their becoming successful. And developing confidence becomes easy because you're showing them they follow the rules, they do what you say, they build up their confidence, and then there's nothing holding them back. So that's what it's all about here, in building confidence. And that's one of the reasons why I like asymmetric strategies, because it makes it easy to build confidence. So what is an asymmetric strategy? An asymmetric strategy, as its name implies, asymmetry, it's not equal, it's not symmetric, where the risk and the reward are very, very different. So as most options traders know, when you get into a spread, say a simple vertical, you are happy as a pig in you know what if you can get a 3-part risk to 1-part reward, or even a more unusual is a 2-part risk to 1-part reward. But you'll also know that that's pretty high delta, and that the odds are probably not terribly in your favor. And so you'll revert back to some really low delta trade where you have a huge amount of risk, like 9 parts risk to 1-part reward. But when you do that, you also know that your probability of profit has skyrocketed. It's now in the 90s, and you think that, hey man, if I can just trade 90% probabilities all the time, I'm going to be a success. Until you're not. Until that time comes when that risk part is challenged and you fail, and you end up wiping out a week, 2 weeks, a month, a whole account. That is the world of most options traders, right? They do play with asymmetry, but they play with it in a way where the risk is huge and the reward is small. So then they develop ways that they can get around it, or ways they can kind of shortcut the process. So what some people will do is they'll put on a strategy like an iron condor, which is essentially a 2 spreads, and they bracket wherever the price is, right? You put the price right in the middle, and the wider you can send out those spreads, the greater the chance that the price will stay inside of your strategy, and eventually profit will fill up those 2 brackets and you'll make money. But again, the standard way of doing that is trying to find some, I don't know, medium between that risk and reward. And the smart trader will try to get the best possible risk to reward that they can, usually, which is what I said, like a 3-to-1. 3-to-1 is about the standard that most people are looking for. Well, let me tell you something. In what we do, 3-to-1 would be a no-go. Quite frankly, 1 to 3 in our case would be a no-go. If these other traders could get a 1 to 3, they would think they were in nirvana, they were in heaven, right? A 1 to 3 risk to reward ratio for me is, meh, I don't want it. I'd rather see a 1 to 5 minimum, 1 to 10, 1 to 20 as a risk to reward. But you'll say, hey, Ernie, wait a minute. You do a 1 to 20 risk reward and you've got no probability of profit, right? You're going to win like maybe what, once a year? Well, that may be true for some, and especially if you're kind of beholden to these ideas and you're carrying around the baggage of a beaten up trader that most of you are. Yeah, you'll think that asymmetry in that way is just not possible. I'm just not going to be able to win enough. Now, I don't know if you saw the movie. I'm sure most of you have. I mean, what trader hasn't seen the movie The Big Short? And you know that The Big Short was all about the financial crisis of 2008, and that was all about asymmetric trades there. That's all they talked about. And do you remember those two guys in the garage that started out with, I think, $140,000, and they made asymmetric bets, long shot bets on companies, and they turned that 140,000 into 30 million. Then they sought out Brad Pitt, who was some guru retired trader, so that they could use his influence to get onto a platform where they could put another asymmetric bet, the ultimate asymmetric bet, to bet against the all these subprime mortgages. So everything, all these people that made the big bucks, they made it by taking asymmetric bets. Now the real challenge here is, how do you put asymmetry in your favor? How do you stay in the game? What works? What doesn't work? And how do you do that? That is a good question. But one thing is for sure, I know that most people that are successful in life, they take enormous risks, right? But there's something that they also do when they take those risks. Those risks usually have huge rewards, but I can tell you that when they do that, they fashion those trades or those moves in the market, so whatever they're doing in business, such that the risk part won't really hurt them, but the reward part can really make their day, make their year, make their life, make their career. Now here's something else that's very interesting. When you make an asymmetric bet, it's not a binary choice, right? It's not, either you make nothing or you make a lot. In options, there's a lot in between. Remember I talked about how premium decays over time until you get to expiration, and that decay happens at an exponential rate. So as you get closer and closer to expiration, it happens faster and faster and faster. So there's an important thing in there, because if you were to look at any kind of options premium collection strategy, like a butterfly or like a iron condor, you'll notice that the premium starts out, well, let's first of all take the shape of an iron condor. It looks like kind of a flat building with angled sides, and the butterfly looks like a tent, right? And that's what the P&L looks like at expiration. So if you're anywhere along that horizontal axis, wherever you touch that tent or that flat top building, that's what your profit or loss is, right? However, when you start that trade, that's not where the P&L is. The P&L, if you were to see like the Thinkorswim trading platform in their Analyze tab, if you're familiar with that, you'll know what I'm talking about. There's this purple line that represents the P&L. And then as time goes on, that purple line is the actual place where, if you took profit on the trade right now, wherever that line lies, that's where you would, that's how much money you would make. But the expiration part is lying above it. It's sitting above it like that. And, I can actually show this here. Let's see if I can, we'll go to the magic of OBS. There we go. I don't know if we can all see this, but we'll make this work.
It looks good, Ernie, looks good.
All right. Let's see, we'll get to the right one here. Okay, here's a good example. Here's a really good example right there. So here's a butterfly, and like I said, it looks like a little TP tent, and you can see where the 0 line is, and these cyan lines represent the actual profit at different time periods, and I have them labeled T1, T2, T3, T4. T4 is where we start out at, right? So when we first get into the trade, our profit is very low. It's right at 0, and it's spread out. The delta or the variance of that profit, whether price goes up or down, has very, very little variance to it. It's a very low delta. And then as time goes on, that profit line grows until it forms directly into the shape of what it looks like at expiration. Now, the interesting thing here is that you could be outside of that tent, like way over here on the left, at some period of time well before the strategy expires, and you can still be in profit. So there are many periods of time where you can be in profit before you ever get to that that final destination, that final expiration. And of course, in this particular case, you can see very clearly that my risk on this trade, if it were put on, you can see that the little wings here, and compared to the 0, there's a very tiny little bit of actual risk. But if I were able to pin this trade and price ended up right in the middle, that amount of reward is huge compared to that risk. And that's the type of asymmetry that I was talking about, by the way. We can look at this, and it's because there are 2 short strikes that define that center, right? And you could get anywhere from 1 to 5 to 1 to 20 risk to reward on some trades when you're doing that. Now, what's to say that I'm going to get in here and get that 1 to 20 or 1? I mean, wouldn't you love just 1 to 5 or 1 to 8 or something like that? I mean, just this past Monday, most everybody that's in the service, they were able to get 450, 500% return. We didn't get right in the center. We got somewhere, I don't even know if we even just barely made it inside here and still made that kind of asymmetric return. So here's the thing. You can put trades on like this and set up asymmetric opportunities and mitigate your risk in that it completely changes the paradigm of the way you trade. So where most people are in, I'm going to go back to the big head here. Hold on. So where most people are drilled into the idea that they have to manage their risk, they say everything is about managing your risk. If you don't manage your risk, you can't make money. I feel like, I'm in that old Pink Floyd movie. If you don't eat your meat, you cannot have any pudding. I'm here to tell you that it's a load of crap. And I say that with due respect to any other trader that's out there. I'm sorry. But the only reason why you have to manage your risk is because you've learned how to be a loser. You've learned that trading is a losing game and your number one job is to try to mitigate how much you've lost. And you might get some wins every here and there, but you're going to get beaten down. And that's the way most people think. And quite frankly, the traders that come in that are seasoned traders, and some of them might have some success, but there's very few. And you know, as well as I do, that that number of seasoned, professional, winning traders is a very, very exclusive club. Most of you have had your successes, I'm sure, and you think that that's really all that exists in your life is the successes, but most of it has been losing. And so you've been taught that managing your risk is the way to go. And that's because you don't know your edge. And even if you knew your edge, you might start waking up start slapping yourself upside the head saying, hey, what the hell am I doing? Why am I playing this game where I have no edge? I thought I had edge because everyone told me I did. They gave me these strategies and the guru over there, he's making money hand over fist, so he says. Now I try it, I make a little bit of money for a few weeks, then I lose a lot of bit of money, I shut down an account, I start back up. That is the life of the vast majority of traders, and that's because they don't understand the ideas behind asymmetry and risk mitigation and putting the odds in your favor and what you can get. I mean, how that changes that one fundamental thing that I was talking about earlier, and that is confidence. If you don't have confidence and know what your edge is in your strategy and whether or not, you know, what to do in every situation because you've built up that muscle memory of being a winner, there's nothing like it. Being a winner and then knowing what winning feels like and then making that ingrained in everything that you do, that's what gives you the confidence in becoming a successful trader. That is the difference between that best trader in the world and that loser that sat next to him that couldn't take the best trader in the world's setups and make anything from it. All right, let me get back to this whole idea of risk. If the risk on every trade that you made was so small that it was of zero consequence, or nothing zero, obviously, I'm being hyperbolic here. But if the risk was so small compared to the potential reward, why would you pay any attention to it? Instead of concentrating on how you're going to mitigate that risk, why not concentrate on how you're going to grab as much profit as you can, considering that's the new paradigm now. If you have the right strategy and you know your edge and you know that that's what you can get and you can put yourself into that position. I mean, those are all big ifs, but it is very possible. We do it all the time. I mean, we average 150 to 200% return on our risk in the bad times, like now, with super low volatility. Tell me your experience with volatility right now. You know as well as I do, with volatility this low, it is almost impossible to have any kind of consistent profits. Now I'm projecting there. I'm speaking about you guys because we're having consistent profits because of we know what our edge is. We put on asymmetric strategies that put us into a position where we do not have to fret over our risk. We're sitting there every day trying to figure out, well, how much profit are we going to make today? Or are we even going to take the trade today? Today we didn't take a trade because it's a Fed day and there are just too many things. Low volatility, markets moving sideways, no range. So what do? We just say, we'll just wait until Friday. And I'll get to that in a second about what the zero DTE is about. So that's a fundamental difference between people that are focused on mitigating or managing their risk, or they're another way, I like to say it's another way. They're trying to manage their losing, how much they're going to lose, because that's what it really comes down to. Let's manage how much we're going to lose. And we're going to buy into this crap that everyone's taught us as if that is the path to nirvana, to becoming a successful trader. Well, what if I showed you a different way where the risk is of no consequence? This is something that people that are successful have found out a long time ago, like the guys in The Big Short. They find opportunities where the risk is small, but the potential payoff is huge. This is also something that venture capitalists do as well. Venture capitalists are always playing this asymmetric opportunity. They will take their $100,000, $200,000 worth of investment capital, and then they'll spread it around to a bunch of ventures. Of course, they do their homework, and they find ones that they feel have the best opportunity, but only 1 in 10 of those opportunities actually turn into anything substantial. And substantial is kind of a loaded word. Sometimes it's, they might, double, triple, go 10x, whatever they were. But then there are some that might go 1,000x, 10,000x. But a venture capitalist doesn't think, well, I got to find that 10,000x in order to be successful. He knows that if he spreads his bets out on these asymmetric bets, asymmetric opportunities, that some portion of them are going to return something. Maybe they only return 25% or 150%, but he can get his money out, he or she can get their money out and be successful. That's why most venture capitalists make on average about 25% return on their investments, which is darn good. Not all of them are hitting the home runs, but some of them are asymmetric enough. They're all asymmetric opportunities that there's something in between nothing and the big kahuna. So that's what people who are real risk takers do. They find small risk, huge reward. They'll take anything in between, but they're always consistently going after those opportunities. All right, so what is it that we do? I put it all together here. And I think we have enough time to do this. We put it all together. What we do is we trade the very last day of expiration on options on the S&P, either the index, the SPX, or the futures. We actually do both. We don't do the SPY because it has really no advantage for us compared to the SPX or the E-mini S&P. Now, the options contracts for those, they expire 3 times a week, unlike most other weekly options that expire only once a week. So we have 3 times the opportunity. Now, what we do is we put asymmetric bets on each one of those days. We are looking to sell options. As I said, remember I said there are edges in this world. There's arbitrage, and then there are the people who sell premium. We sell premium with premium collection strategies like the butterfly that I showed you on that last day of expiration. And we put it in such a way, or place that butterfly, its short strikes and the width of those strikes in such a way that give us a chance to either pin the trade or make something in between. And we can put those strategies on so that our risk is very small, but our potential profit is very, very large. And hey, if it doesn't reach the center of that strategy, that's okay. Like Monday, it only went about a quarter of the way into the strategy, but we made 450%. Who wouldn't want to make 450%? We have other times where price never even enters the butterfly, and we still profit 100, 120%. Sometimes only 50%. Who wouldn't want to make 50%? Those are our really loser days. So it's not asymmetric betting is not binary. It's not either you lose or win big. There's a lot of in between, as I explained with this and venture capital, as well as anybody that's, a risk taker out there. They know how to play those odds. So how do we do it? How do we ensure that we place that butterfly in such a way that gives us the best opportunity to profit? Well, first of all, we use the principles that I've talked about before, and that is that we have the selling or the net selling of premium is on our side, and the overstatement of premium, that's all on our side. We have time on our side because time represents that P&L line that's growing, and as long as we're sitting there somewhere, that P&L line is like the tide coming in on a boat. It's lifting us. We don't have to even move anywhere to make money, but if it starts moving in our direction, that amount of money that we make starts exploding. So we do some things a little bit differently. First of all, we reject using technical analysis because there's no edge in technical analysis. Now, you may argue with me there. It will be a losing argument, guaranteed. And I take on those arguments. Please bring them on, because your technical analysis and your price action are crap. All the indicators you use are crap. We do one thing. Well, we do two things, actually. It's a melding of two things. First of all, we want to have a general direction, or in mind, a general direction where the market is going. Is it going up? Is it going down? Or is it staying the same? And if it's going up or going down, is it going up fast or slow? Does it have momentum or not? Is there a catalyst behind it, like an economic report or a geopolitical condition or something? And the cool part about it is, because we're doing it on the 0th day of expiration, we only have to get that direction somewhat right in a very, very short period of time, and then place a collection strategy in the way to either lose, which we lose about 20% of the time, or win something. And on average, we're bringing in, like I said, in a very thin time, about 150, 200% of our risk capital that we put up. During more volatile times, what I call the Goldilocks zone for volatility, and a lot of traders talk about this, that Goldilocks zone is, at least currently, is between when the VIX is at 17 to 34. When volatility is up there, we're winning at the rate, instead of winning at the rate of, say, 65% of the time with 150% return on capital, we're winning 85% of the time with 250% return on capital. And instead of pinning the trade 10% of the time like we're doing now, where we are making 900%, 1,000, 1,500%, we're doing that almost 25% of the time. Not actually, remember I went back and I said, man, that seems like a very small opportunity to try to pin the trade. We don't have to pin it exactly. However, using some of the techniques that I'm going to talk about in a second here, we can pin it way more often than you think without using technical analysis, with using something that I'm sure a lot of you are familiar with, and that's volume profile. Volume profile is a very interesting thing that helps us tip the scale and put more asymmetric strategies in our favor. And you may wonder, well, why is that? And a lot of you may only know volume profile as those funny horizontal bars on the side there that you see in some charts. You have no idea. Well, volume profile is like the original order flow. It is telling you, first of all, here's another thing. Volume profile is not an indicator in the same way that RSI or MACD or moving averages are indicators. And that is because the volume profile is not a calculated entity. It is, in fact, the raw data from the market. It is the number of transactions that have happened at specific price levels. That's all it is. Nothing else. Now, what's interesting is when you see these profiles on the side, they look like little nodes, like this, right? Each one of those nodes represents an area of heightened volume that the market has decided that there's value at that level. And then in between those nodes where there's no value or no volume, I slipped up there because I'm about to tell you that those are places where the market has decided that there's no value. Why? I don't know. I don't care. All I know is the market finds value at certain levels, like right now on the S&P. If you were to look at the E-mini S&P, you'll find that an area at 4440, price has been hanging out right there, and it's building a big volume node. What does that mean? It means that the market has found value at that area. And price has a tendency, as it's, say, traversing across these volume nodes, to gravitate towards those nodes. That's because that not only is that the current situation, but that is also the situation in the past, that people have taken trades or taken positions on those nodes that still exist today. Not all of them, but most of them, and at least proportional to what you see on those volume nodes. So what you're looking at is the current map or structure of the market when you look at volume profile. And so what does that mean? Well, that means that we can make a lot of very, very important decisions here and assumptions. One is that if price were to go up and there's volume nodes there and the absence of volume nodes, it's going to act in kind of a unusual way as it traverses across that structure. I like to think of it as kind of like if you've ever been into the desert, right? You ever, there's the desert, it's really flat and super hot, and then way out in the distance, you see where the desert breaks and there's mountains and greenery and all sorts of other stuff. When you're going across that desert, you're going like a bat out of hell because you do not want to get stuck in that desert when it's 120 degrees, and you make a beeline for those mountains. When you get to those mountains, you slow down super slow, take it all in, it cools off. You find, some people there, maybe you find some pretty girls, and you want to hang out for a while.
I wish we could hang out longer, man. I hate to interrupt you. I'm so sorry. How are people going to get in touch with you?
You can go to 0-dte.com. That's 0-dte.com. Don't forget that dash. It's super important.
I'm going to post it into the chat. I think I have it right here.
Let me just say those volume nodes is what we use to place those butterflies over.
Oh, yeah. All right, folks. And how do they need to email you? Just come to this page.
No, they just come to the site. We have a 4-week trial. You can hang out for 4 weeks and try it out.
All right, excellent. I'm so sorry I had to interrupt you, but we have somebody already waiting, and I kind of guarantee that we're going to go right on time, and this was awesome. I really hope you'll come back with us again. And I hope you have a great day. Folks, if you have questions for Ernie that we didn't get to, which we didn't get to any, please go to that page and get in touch with him.
Thank you very much.
Thank you, sir. You have a good day.
You too.
All right. All right. All right, folks. I just wanted you to see. There is the link again, https://0, that's a 0, not an O, -dte.com/try to be able to get in touch with Ernie. And our next speaker coming up is, let me just run over this real quick. Sorry about that. If you have to leave early, we do post the recording of these webinars at tradersexclusive.com/archived webinars. And you'll be able to see all of the other webinars that we've had coming up. We've got our next dates coming up. If you see the green arrow at the bottom of the screen, you click on the word here, and it takes you to the page where you can actually see all of our previous webinars. And I want to introduce to you our next speaker is Hima Reddy, and she's bringing us Not Your Mama's Momentum, how to profit in any market on any time frame. And she is a veteran Wall Street analyst, and she's known for uncanny predictions on market moves and her ability to make trading simple. Hima is on a mission to empower traders to take control of their financial future so that they can live the life that they and their families deserve. Hima, thanks for being with us and thanks for waiting. Let me just make you the presenter and we shall go.
Okay, great. Sherry, can you hear me?
I can hear you very well. I'm just getting over here. There we go. You should be able to present your screen now. And just to know for sure, do you like to have questions in between, or would you like them to hold them until you're done?
Oh, I'll take them at the end. So that would be great if you can keep an eye on those, or if there's a place in the chat for me to see them. I love it even more when I can see the traders that are here with me. So is there a place I can see folks chatting with me and all that? Great.
Yes, I'm going to make it so you can see that.
Awesome.
Okay, now you should have that capability on your GoToWebinar menu there.
There's a chat, there's questions. Ah, I see it. So
there you go.
It looks like it's the questions box. Okay, wonderful. Right. Well, thanks, Sherry, for the intro, and thanks for having me.
Just let me know when you want me to put the link on the screen.
Will do. Okay. So everyone here, I gotta say howdy, because I've just moved to Austin, Texas. This is my first day in my new office, and so I really pushed hard to be able to be here with you guys. Just a heads up, internet got set up and everything, but you know how moving goes. So if you have any issues, please just shout and I will do my best to accommodate. So if you can hear me and see my screen, please type a yes for me in the question box. That way I know who's here, who's ready to learn, and who's ready to dive in. Awesome, thank you, John. Yes, welcome to Texas, he says. Where are you, John? I'm, like I said, in Austin, a little east of downtown here. Okay, Festo can hear me, wonderful. Mazin, or is it Mazin, can hear me, thank you. John, Dallas, okay, not too far off, awesome. Okay, welcome, Matt, Martien. You guys have some cool, unique names. I'm not the only one here. All right, awesome. Well, we've got a limited time here. I want to help Sherry respect the schedule, but I also want to make sure you guys know what you need to about Not Your Mama's Momentum. So it's awesome to be here today, and keep telling me where you guys are from, not just the Texans. I want to know where everyone's from, because I think that's one of the coolest things about trading, right? You can do it from anywhere in the country, around the world. I mean, I think that's part of the amazingness of it. And so let's dive in here to trading momentum with Not Your Mama's Momentum, how to profit in any market on any time frame. So you're going to learn how to trade momentum. You're going to get a sneak peek behind the one Jedi indicator that helps me accurately predict turns and large moves in any market on any time frame. Awesome. We've got Festo from Kenya, fantastic. We've got Martin from the Netherlands. You guys are proving my point here. Arturo from California, love it. All right, guys, so let me ask you, have you ever wondered what it would be like to have an expert analyst in your back pocket? Have you ever wondered what it would be like to finally trade with confidence? Have you ever wondered what it would be like to finally make enough with trading that you could live the life you deserve? Would you like me to share an easy way to amplify the power of an indicator that's in every single trading system out there? Would you like me to share an easy pattern that allows me to predict trends in price and momentum for you? Would you like me to share an easy way to trade futures, stocks, and options? How many of you want to get as much as possible out of our time together? I want that for you too. For most of you here with me today, this is going to be a long-term relationship. Once I show you how simple this is, once I show you how easy it is to consistently extract money from the markets, once I show you how fast your business and life can grow, you'll want to hang out with me for a lifetime. Now, in a moment, you're about to discover how to make money with future stocks and options, even if you suck at picking them yourself. You're about to discover how to capitalize off making trades at the best prices and the best times. In a moment, you're about to discover how to catch market turns and ride the price waves up and down in only minutes a day, Would you like me to show you that? All right, awesome. I promise that by the end of our time today, you'll know everything you need to pick the best trade, when to enter, and when to exit in only minutes a day. Would that be okay if I pull back that curtain for you? Great, because here's the problem. Many traders are making it way too complicated. Many traders are getting hammered by the trends because you haven't found a consistent way to produce profits by yourself. And it's not your fault. They make it complicated. As you listen to me now, know my intention is to help you fix that problem because you're ready to take action now. Notice, I'm going to be absolutely upfront and transparent with you today. I'm going to show you current case studies and figures today. As you all know, trading involves risk, and it's your responsibility to evaluate any information, opinion, advice, or other content contained within my presentation. Your results are up to you guys. I can't predict them. I'm not going to predict them. Anyone who says they can is lying to you. All right, I don't know your trading plan, your account size, or your markets you trade. I can only show you what's working for myself and others. Your success is up to you. So who am I and why listen to me, right? Well, if you haven't been following me for a while, here's a mercifully short introduction. I'm Hima Reddy, and I'm originally from New York, the hotbed of the markets. Now, I started out at 16 years old learning futures trading from my dad, a successful trader in the Gann style of trading. In fact, my dad was so far ahead of his time that he got a chunk of Amazon stock right at the beginning. Then I became a certified CMT working as an analyst at Piper Jaffray before going on my own to help traders directly. And over the past 20 years, between my professional analysis on Wall Street and my international publications and my proprietary analysis and education, I've helped hundreds of thousands of individuals create a sound plan for their financial future. I'm an international speaker presenting to institutional portfolio managers and analysts, as well as individual traders. And I've been blessed to appear in the Wall Street Journal, Barron's, Bloomberg, Reuters, The Street, Benzinga, and all the media alphabet. I'm also the author of The Trading Methods of W.D. Gann. So how did I get here? Well, that's quite a story. Is it okay if I take a few minutes and tell you my story? It'll go by like that. Okay, so here we go. Now I'm a successful trader and educator, but it hasn't always been like this. Years ago, life seemed great. I was in the center of the action as an analyst with Piper Jaffray and making them a ton of money, starting work at 5 a.m., working late, and burning out quickly. Is anyone else here a corporate cog making someone else rich? I know, right? I thought there must be more to life. You know, the money was really good, but I never get to see my family. You know what I mean, right? I started becoming a ghost in my own life. I'll never forget the moment the bottom dropped out of my world when my beloved dad and mentor died suddenly. At first, it felt like my whole world was crashing in because I had to leave my job to tend to financial and legal family matters. But then I realized this was my ray of light, my hope to get out of the corporate grind, and I seized it with both hands. You see, while I was apprenticing with my dad to learn the markets, I had started a futures report that I called my Skinny on the Mini. It started out as just another exercise, but soon my dad started making money with it and relying on my little report. And then I shared it with other traders too, and they were benefiting. But all of that stopped when I joined the corporate world. Conflict of interest, am I right? And all those years, those traders were hounding me to get the report back. So when I had to leave my job and take over my dad's accounts to trade for my mom's future, I realized that it was time to bring back the Skinny on the Mini and reclaim my life. I sent out the call to my former subscribers and they said yes, they would love to get back my report that ROI'd on average 7 times out of 10. They couldn't wait to leave the hard work to me again. The result? I had time to trade my dad's and my accounts again. I started maximizing the trading methods of W.D. Gann and became the leading expert on Gann. I started teaching others the hard-earned secrets that I had learned from my late father. And in a moment, I'm going to share those very secrets with you. Because what I've discovered is that trading equals freedom. All right, guys, trading equals what? Right, freedom. Type it for me in the chat if that's what you're here for, right? There's only so much time in each day. And when I found the system, I got my time back and my family back. And that's freedom, right? Clearly, that's what we all want, right? Freedom. Wouldn't that be awesome? But clearly, there are challenges. Many traders lose money because they don't have a proven system. Trading often feels complicated and overwhelming. Often it can be confusing, right? Well, they made it confusing and complicated because you don't have a simple proven system. Because what I'm about to share wasn't available until now. And now that it is, you've got to have your 4 zones RSI coverage system. And you'll immediately notice how much easier it is to make money trading future stocks and options. And I'll show you that a little later. So what is different about the 4 zones RSI coverage system? The 4 zones RSI coverage system gives you my Jedi indicator and system that helps you accurately predict turns on large moves in any market on any time frame. But more on that in a bit. First, we're going to dive right in. All right, guys. So topic 1 for today, momentum made easy. Trading momentum can be easy, but first you need to understand how it works. And a Formula 1 car racing track will have you understanding momentum in no time. So if you guys are ready to go to the racetrack with me, type a Y for me in the chat. I gotta make sure that you're ready and willing and listening so you can make sure you learn what I have to share here today. All right, awesome. Got Festo's with me, got Mason's with me, fantastic. Michael, awesome. All right, let's put ourselves in the driver's seat, okay? You're at the starting line of this track in that hot little red car, right? So you rev up your engine and you go. You pick up speed really quickly, or what's called accelerate, on the straight runs of the track. Then you see a turn coming up and you prepare accordingly. You ease off the gas to slow down or decelerate, even if it's just a little bit, so that you can have more control as the car whips to the other side of the turn. Then after you make the turn and the road straightens out again, you hit the accelerator once more. Are you getting the idea of how you'd accelerate and decelerate on this track? Well, now you know exactly how price momentum works. All right, now let's take ourselves out of the car and up into that helicopter in the top left. See it here, with my mouse circling it? Okay, now you are flying the helicopter and you're gonna look down on the racetrack with me. When you look down on the racetrack, getting that bird's eye view, the racetrack becomes price as you see it on your stock charts, and momentum is generally plotted on the bottom as a subchart. Making sense? All right, now when price is trending higher, you've got upward momentum that's improving. That upward momentum generally begins to slow down and what's called before price does, making momentum a leading indicator. Momentum is leading price. Are you getting this, guys? Type a Y in the chat so I know you're with me. All right, great. Now, during falling prices, there's falling momentum that's becoming a more and more powerful force. But when a price bottom is approaching, you usually see momentum bottom first. Therefore, momentum indicators can warn you about hidden strength or weakness, giving you a heads up, especially when it comes to potential market turns. Making sense? All right, awesome. I can see you guys have got this. Mason's got it, John's got it, Festo, Fred, Mark. Awesome. All right, now we're going to dive into the indicator. But first, let me share with you results from our trading family. Hima, I value your insights. Your momentum indicator is an integral part of what I've put together. I believe I'm ready to go from paper to live trading, said Jim. All right, now that we've made momentum easy to understand, in a moment, I'm going to show you how you can make money trading momentum. But first, you guys want the Jedi secret? My Jedi twist on momentum? All right, cool, because I'm going to let you peek behind the scenes of my trading and show you how momentum moves through the markets that you know using my special Jedi indicator. And that indicator is called the RSI power zones. And you can use it on any market in any time frame. So take a look here, guys. I want you to type in the chat what market you trade and what time frame you trade on. Here are some examples. Okay, indices could be the SPY, could be, well, indices could be your S&P, I should say, NASDAQ, Dow, right? ETFs could be the SPY or the DIA. Stocks are obviously, Apple and Netflix and everything in between. Because I want you guys to tell me what you trade so that when we have a few minutes here at the end, we can also go to the live markets and look at those markets with my Jedi indicator. Fantastic. I love you guys sharing this here. Festo trades Forex on a 15-minute. Marks does futures on a 5-minute. I do futures on a 3-minute. Love it. Victor does 10 minutes for our NASDAQ. And then we've got John doing Forex as well. Tony is a daily Forex and SPX. Awesome, guys. So you're going to see on a variety of time frames today and a variety of types of markets how the RSI power zones work, okay? So let's dive into a very popular combination, which is a commodities chart. But let's look at it a monthly time frame. Maybe you trade commodities on a daily or 60-minute chart, but I want to take you to a big picture of something we all know, whether we trade it or we look at it at the gas tank. That's right, oil. So here is a monthly chart of oil, okay? Every candlestick is representing 1 month of price action. Now, do you guys see this black squiggly line at the bottom with these 4 zones, these 4 pairs of colored lines? All right, that is what creates the RSI power zones. So the two lower red lines are your bear support power zone. And I'm going to walk you through what these mean as we uncover this oil chart. The two lower green lines, okay, the spacing between them, creates the bull support power zone. The two upper red lines is the bear resistance power zone. And the two upper green lines is the bull resistance power zone. Now, looking at all of these zones, we're going to look at the history of price action versus what happened in the power zones. Remember, this is not your mama's momentum. This is the Jedi twist, the way you get more out of momentum. All right. Now, you may have noticed that from the piece of the chart I had before to here, there was a huge advance up in price, right? Strong advance higher. Notice how on the RSI power zones, there was a move from the bull support, the lower two green lines, to the bull resistance. Do you guys see that? Can you type a Y in the chat? Because this is RSI power zones, like elementary foundational level. And if you can see this, you'll be able to learn and capitalize on this. All right, awesome. Now this was evident on a monthly time frame. So what it did is get you ready for when the power was sort of, falling out of this upward move. Now what happened was very quickly, after just touching the bull resistance power zone, price fell sharply lower, and you can see that the RSI fell to the bear support. Now, I was an analyst on Wall Street, watching and analyzing oil and many other markets, still using my multi-time frame analysis, looking at longer-term charts and shorter-term charts. And I told my clients and my colleagues, listen, I don't think this is a one-and-done fall here. I think oil is going to be in trouble for some time. And they were a little skeptical because they thought there'd just be a bounce after a move like this. But here's what happened. Years of this giant sideways range. And the thing is that, as you can see with every one of these yellow vertical lines, every single high that formed in price after that peak in the consolidation was tied with the bear resistance power zone capping momentum. This was another clue to me that would tell me the future direction of the breakout. So from a practical everyday point of view, after falling to $100 a barrel, most people thought there's no way it's going to fall lower, right? We're going to climb back up to 150, 180 and go up from there. Not so much. We had another drop, very substantial, and both lows in price saw the RSI power zones push down into the bear support power zone and continue to pressure into there. By having this entire zone at the bottom here, guys, it made it easy to maintain the selling mentality with the downward price move instead of getting excited every time some random level called oversold was hit. Now, from here, you may wonder, was there a recovery? Absolutely. But even that initial recovery on its first attempt higher had the RSI cap at the bear resistance power zone. So this is a piece of history of a very important chart, but you might be wondering, well, what's it doing today? Well, I've got that for you here. You guys ready? Okay, remember here where we are on this yellow line, okay? On the next chart, there's going to be a gray line that's going to pick up where this dropped off. So this gray vertical line is picking up and showing you what happened after the last chart finished up. And I caught this literally today, like an hour ago. I captured this screenshot Wednesday, August 18, 2021. There's no way I could have known what the chart would look like, right? So now let's look at this together. Again, the gray vertical line marks where the last chart left off. So do you see how oil futures, follow my mouse here too, they traded lower, okay? They came down, had this sideways correction, fell again, and the RSI went back to the bear support power zone at the start of 2020. You guys see that? Now we've been recovering higher since, and oil continues to have promise to the upside. The thing is, on the shorter term time frames, daily, weekly, and more, you can use the RSI power zones to navigate all the ebbs and flows of this recovery higher and be able to trade it. So this is the RSI power zones as applied to a commodity that we all know or trade on a monthly time frame because of the importance of history. Can you see how looking at the RSI power zones on oil might have helped you better navigate trades in oil or markets related to it? Please type a Y for me in the chat if you see that, guys. Okay, it's sort of like learning that there's a fourth dimension to your indicator. You just thought that what was there is all you had, and now I'm telling you, no, there's another way to look at it. Awesome. Okay, Festo's got it, Mason's got it, love it. Now, let's take a look at another popular market and time frame. Let's look at an ETF on a weekly chart. And this is one that a lot of my coaching students trade. That's why I know it really well. This is the S&P 500 ETF, so SPY, SPY. And here I've got the 4 power zones for you here again as a quick reminder. Now here we have every candlestick representing 1 week of price action. So again, take a look at history and then we're gonna look at what's happening today. Notice there was sideways action on the SPY for like 2 years. You see all that sideways defined by that dashed horizontal line? Okay, price then broke out above it, follow my mouse, and then pulled back down. And that pullback where the yellow highlight is, look at how the RSI power zones held the bull support power zone. Let me be clear. You would not have seen this as an opportunity to go long or build long positions if you were using just the traditional approach to momentum and the traditional RSI, your mama's RSI, if you will. Okay, you would have totally missed this. You've got to know RSI power zones to be able to take advantage of moves like this. All right, what happened from there? Well, there was a big advance higher, and that whole advance saw the RSI continue to improve, ultimately reaching and extending beyond the bull resistance power zone. Okay, always remember that the RSI, it's called an oscillator because it lives between 2 fixed numbers. It's brought back to that, okay? It's measured to that. So it's living between 0 and 100, and it can go all the way through any of these zones at any time. It's just that having the zones in front of you helps you navigate most moves. So this was a really strong market that edged beyond the bull resistance power zone. And then what happened from there was a very sharp move to the downside. In 2 weeks, we took out the price action of the past 10 weeks, right? And a lot of people were kind of scared by that. And they thought it was going to be the beginning of this big, bear market or something. But I saw what this was as this market just relieving itself of overbought conditions, like a pause to get a drink of water in a marathon. So when I was writing the skinny on the mini, my futures report at this time, I told them, hey guys, this is just a sign we're going to go sideways for a few months before the uptrend resumes. And that's exactly what happened. There were all of these sideways moves that unfolded in this correction, and the RSI held the bull support power zone the whole time on the weekly chart. Okay, it's like a slinky, all right, that tells you how old, or I guess how young or how old I am. I played with slinkies when I was little. Those are those toys that coil up and then they release into long coils when they expand again, right? That's what the market does when it's consolidating. All that pressure is coming together before there's another explosive move. All right, guys, now from here we had another break higher, and it coincided with the RSI power zones resuming higher once again. And these relationships between price and the RSI power zones are evident in a variety of markets and timeframes, which we're going to continue to see here today. So let's take a look at where we are today. All right, so the last chart left off at this gray vertical line. We've had a lot of action here with the RSI and the weekly SPY chart. Where are we most recently? Let's take a look. Notice that the RSI is continuing to trek higher. It's going slow but steady. And price is continuing to make higher highs as well. So as per the weekly chart of the SPY, there's nothing to be super alarmed about some sort of imminent crash or anything. We would need more time and more data. And we can look at this in a more broken down way when you go to a smaller time frame. I'm just kind of getting you guys to get to know the RSI power zones on a monthly chart and a weekly chart. So can you see how looking at the RSI power zones on the SPY the past few years might have helped you better navigate trades in the SPY or markets related to it? Please type a Y for me in the chat if you guys are seeing this. So now we're going to move on to our next topic. All right, fantastic. Now we're going to dive into the trade setups. But first, let me share with you more results from our trading family. Susie shared, my first month using RSI power zones was also my best trading month so far. Now, by now you're getting it. So we're going to dive into my proprietary 3-step approach to using RSI power zones to find great trade setups. I'm going to show you actual setups that I use and share with my trading family. All right, so here it is, using RSI power zones to identify trade setups. So if you guys don't already, take out your notepad, take out your app, whatever you use to take notes, and jot these 3 steps down, okay? We're going to see them over and over in the next few slides with the case studies that I present. So step 1, review the chart and assess the price trend. Wait, hold up, Hima. This whole time you've been talking about momentum. Now why are you talking about price? You might be wondering, right? Because price is king, guys. Price rules your charts. Price is the source of data from which momentum is even derived. So you have to know what price is doing to make the most of momentum. You will benefit much more from it by being aware of the price trend first, okay? Awesome. So when you make this assessment, and I'm going to show you how in a moment, you're going to have 3 choices you end up with: uptrend, downtrend, or sideways. And yes, sideways is a type of trend. We can prepare for trading the next directional move if you know how to monitor the momentum of the sideways action. All right, step 2, evaluate the RSI power zones reading. This is specifically looking at the RSI value relative to the 4 power zones, okay? So each zone has a distinctive upper and lower boundary, and there are 4 total zones. So you always just want to know where is the RSI relating to these zones, and then the dead space in between the zones, I call no man's land. And we'll see that more in examples coming up. So here you're just recognizing where the momentum even is. Got it? All right. Now step 3, determine the presence of an entry signal between price and momentum. Now usually the best signals or setups come from when momentum and price are not connecting. They're not jiving together. That's usually an opportunity that we can take advantage of for profit. All right, guys, so you've got your 3 steps to using RSI power zones to identifying trade setups. And I'm going to repeat these steps over and over and over these next several minutes. So you're going to have them down pat by the end of our training. And the best way for you to learn is by using actual examples. And something I pride myself on is that I practice what I preach in the analysis I share with you. Hey, traders in the Hima Reddy tribe get updates from me. My members get even more detailed updates. And every single example we're about to look at here, I called out to my members as it was happening. I did not just have it tucked away in my back pocket and pull it out as a beautiful textbook example, right? Anybody can do that. I'm showing you actual calls that I made. So I want you to type a Y in the chat so I know that you see the value of what you're about to implement here. That I'm showing you actual calls I made live, not just, what looks nice in a textbook, but nobody got to trade. All right, super. All right, so let's dive in here. Let's go back to our different markets and time frames, and let's grab another combination here. Stocks on a daily chart. Do we have any stock traders in the room here? Let me know. Because here we've got Netflix, which is a stock you guys asked me about a lot in our monthly review sessions, those of you who trade the FANG complex. And here, this is a daily chart. Every candle represents 1 day of price action. Now we're going to deploy the steps that I taught you, right? Step 1, review the chart and assess the price trend. So I'm going to help you out for this one. My key pro tip is that no matter what you're trading, Forex, stocks, futures, options, if you're looking at a daily chart, determine the trend by looking back at least 6 months or so. It gives you a good background of information. So going back to the beginning of this chart, you can see there was this extreme and a high here. Then there was a series of smaller moves and it fell down to this level, right? We rallied, including a gap, corrected lower again, rallied again, and currently, based on the time of this chart, when I called it out to the tribe, had been pulling back. So this is what I would call an uptrend in price with a corrective pullback in motion, meaning we're not on the new upward side, we're in the corrective pullback part. Okay, type a Y for me if that made sense. If you think you can do that in your charts. All right, awesome. Now, what's step 2? Evaluate the RSI power zones reading, right? Here you can see that it's holding the bull support power zone. So this is a helpful clue that we might be more beneficial looking for long setups if they occur. All right, great. Step 3, review the chart and assess the price trend. Step 3, determine the presence of an entry signal between price and momentum. Clearly, there's still cardboard box fumes wafting through my head of moving. All right, step 3. Now, this is the thing, guys. There are various setups here that can occur between price and momentum, and some of them you can even use to calculate price targets. So the setup that I saw here that was actually happening on Netflix, I sent an email to my tribe and I said, hey guys, I see this as an opportunity to buy Netflix based on this setup that's unfolding. And here's what happened. Do you guys see that? Look at the size of the move that followed. We went from this low at 271.22 to this high 423.21. A 56% move higher to be able to take advantage of. And I have a whole training that dives into RSI power zones for true mastery. And I'll show you the signal in module number 2 because I can't teach you everything you need to know within an hour, okay? It would do you a disservice and it would shoot you in the retirement Yes, I said shoot you in the retirement. Money isn't just money, guys. It's the blood, sweat, and tears that it took you to make it. And you can't afford to lose any of it. So I'm here to help you maximize it. And of course, I can't teach you everything that I've learned in 20+ years in under an hour. So warning, don't do this at home without help. After all, that's what brought you here today. If you could do this without help, you would not be here. So in a moment, I'm going to show you what you've been missing, and then we can look at how I can teach you more in depth. Making sense? Are you guys getting this? Okay, awesome. Because now we're going to dive into another one of your favorites. Here's Twitter, all right? So another daily chart with a stock as the security. So we do the same steps. Step 1, review the chart and assess the price trend. I'm just going to highlight the circles for you, and those of you who've been participating today, you tell me what the trend is. All right, there's your data. I've highlighted some of the key highs and lows. Is this an uptrend, downtrend, or sideways? Let me know in the chat. Yeah, awesome. Festo's got it, Arturo's got it, John's got it, fantastic. Now, as an extra layer of information, this is an uptrend in price with a corrective pullback in motion. That way you kind of know where you are, right, in the stair-step move. Fantastic, nice job. Now, step 2, evaluate the RSI power zones reading. Can you see where the RSI power zone line is currently? Yeah, it's just like that Netflix chart. It's holding the bull support power zone. It's in there after kind of skimming by it, all right? Excellent. Now, the really cool thing about this one, guys, is that I didn't just notice this on my own. I actually had a live class of students just like you where we saw this. And I said, hey, I see a setup and we're going to calculate an upside target. So based on the target or the setup occurring here for step 3, as early as April 10th, you could calculate an upside target for 39.13, okay? And I shared that with the students and I taught them how to do it and everything. So that's the determination of the presence of an entry signal between price and momentum. From there, what happened? Check it out. We rallied, nice and slow and steady, many opportunities to get in long with risk reward that fits your trading plan. And on June 10th or June 5th it was, we met the target. So we had a couple of months to be able to get in on that action. And again, I have a whole training that dives into all 4 of the RSI power zones and all the related setups, and I'll give you the signal in that system. I'm just showing you here what you didn't know that you didn't know. The trading can be simple when you follow the expert. Making sense? Are you guys getting this? Okay, I've got one more case study, and you FX traders are gonna love this one. So here we've got an FX chart, again, in a daily time frame. And again, I call this out to the tribe as it was happening. So here we go. Step 1, review the chart and assess the price trend. I should sound like a broken record now. Now in this case, we've got a little bit of different looking price action. High, low, lower high, lower low, lower high, lower low, lower high, lower low. You guys tell me, what is the trend here? Awesome. You guys are getting it. I love it. John's got it. Arturo's got it. Michael's got it. Absolutely. This is a downtrend in price. Now in this one, we are not in any sort of corrective motion. This is just a straight up downtrend, right? Now here's the thing. Where is the RSI? Step 2, evaluate the RSI power zones reading. It moved from the bear resistance power zone to the bear support power zone. So looking at the way that the RSI is moving is part of what you can evaluate when you do step 2, not just its current location, all right? And you'll be able to pull more and more information for your step 2, the more comfortable you get with your RSI power zones. Now here, step 3, determine the presence of an entry signal between price and momentum. Now, the setup here is different than the ones I showed you on Netflix and Twitter. Those were sort of offensive setups, if you will, where you could set up a new position to enter a market. The one that showed here was a great defensive setup that if you had any sort of short trades on, it would warn you to start protecting your profits. And then after that, you would be able to use price, time, momentum, my whole trifecta of analysis, and be able to take advantage of any move that might unfold. So this was a warning that the trend might be changing, guys. And so if you had a short position on, would you have appreciated a warning that the trend down might be over? I would think so here, right? You'd want to protect those profits. And this is what unfolded. Look at the size of this move. We went from the low at 0.9186 to the high at 1.0050. Now in FX land, there's a little bit of conversions and other things you have to do to get there. But I double checked with my FX professional trader friend, and he's like, man, Hima, I wish I was getting your alerts and your notices at the time that you called this out, because this was an $8,600 move just based on one contract. And again, I'm showing you calls I actually made to the tribe using the same setups that I teach. And I'm very excited to be sharing this with you today because I'm really, really passionate about the work I do to provide traders with the best analysis and education to trade the markets so you can take control of your financial freedom and live the life you and your family deserve. So by now, you know that power zones on the RSI can really boost your trading, because whether you're new to studying momentum or you've been doing it for years, this approach can really help you extract more profits from the markets and be more consistent. And consistent profits is what it's all about, right? Making sense? Are you getting this? Type a full YES for me if you want more consistent profits. That's the biggest thing I hear from my traders. Consistency, right? Not just a win here and a win there, consistency. All right, awesome. John wants consistency. Fester wants consistency. James, Victor. I should see everyone in here writing a yes in the chat. And that's the results our trading family loves seeing too. Like David. I installed the RSI Power Zones indicator, and it's just amazing how accurate it is on all markets. It actually gives advance warning before the price moves. So let me ask you, did I provide value for you today? Did you learn? Are you ready for more? Then it's time to master RSI Power Zones. So far, you've heard about how I've come to really benefit from using the RSI Power Zones. Here's what more of my students have to say. I was very impressed with the education Hima provided that came with my indicator. Hima's RSI Power Zones indicator has become the standard in all of my charts, said Rob. Norman shared, a day after learning one of Hima's RSI Power Zones trend continuation entry signals, I tested it out on a 5-minute chart of Tesla. With this one trade, I made over triple digits, covering the cost of her newest course. I got your RSI Power Zones training, and the next morning on the market open, I found UNH as a short candidate using the weekly chart. By the time I sold the position, it nearly paid for the whole course. Thank you for sharing your knowledge and keeping your content reasonably priced, said Aaron. So, will you be our next success story? Making sense? Are you getting this? How simple it can be to trade when you have help? Great. So imagine and picture this. You, finally able to turn your trading around and make money with trading and live the lifestyle you've always wanted. Giving back to your communities the ways you've always wanted to. Sounds great, right? Spending all the time you want with your kids and grandkids. Great. So here's what I've got for you. This system that can give you all this is the 4 Zones RSI coverage system. Before I give you this opportunity, let me show you the features and benefits using the system will give you. Rapid results. You can learn to use the system in as fast as 60 minutes and you'll be up and running. It's perfect for any account size, $5,000 or $10,000 or $100,000 or $1 million or more, you can trade this. You pinpoint your trades faster so it takes less time. Get more profit because it's perfect to add to whatever you're doing right now. Perfect for beginners, so easy that anyone can do it. Perfect for experts to diversify their accounts because the 4 Zones RSI coverage system gives you all this. But first, who is this not for? This is not for those who are trying to get rich quick. Like anything worthwhile in life, trading takes consistent work to get consistent returns. So if you're here to play the slot machines, this is not for you. So who is this for? This is for those who are ready to analyze the markets like the expert to optimize and boost their trading. This is for those who want to diversify what they're already doing for additional profits. This is for those who are ready to step up and take action for their own financial freedom. Since you're still sitting here with me, you're taking the time to learn to boost your trading. You're ready to take action now because it's time to remember what you forgot to remember. You can let it be easy. Now in my 4 Zones RSI coverage system, I give you my 20 years experience on a silver platter, and it's 100% focused on step-by-step systems, instantly accessible, starting with video tutorials where I take you by the hand and you move through the 8 phases of a trade. So you have a complete system to your approach so you minimize mistakes. I give you my top RSI Power Zones trading signals from my years of study and observation with various real-world examples across multiple markets and timeframes. I walk you through the best entries, exits, and protective stop strategies so you can extract the most profit from the market using RSI Power Zones, and much, much more. Now, to make it even easier, you'll also have cheat sheets that you can download and print out and keep right by your trading desk. Are you getting this? I mean, these are like those things you get to do in middle school, maybe high school from your math or science teacher, right? You learn a concept on Monday, they pop quiz you on Thursday, they let you bring in that half sheet of paper with the formulas, at least they used to. Well, that was awesome because it helped you ace the test and learn faster. So these are easy to read grids like this, along with step-by-step trading strategies, all filled out, moving you faster on your path to boosting your trading account by speeding up your learning. Now, you're gonna love this, okay? This is the very thing everyone's always pestering me to get, but I had to have it specially coded for you. I'm also including the RSI Power Zones indicator. They are programmed to the exact settings that I use and are available for all the platforms listed here. TradeStation, Thinkorswim, NinjaTrader 7, NinjaTrader 8, MetaStock, MetaTrader 4, MetaTrader 5, eSignal, Ensign, Sierra Chart, Trade Navigator, TradingView. And this is a no limit download, guys, okay? You can download the indicator for as many platforms as you like, to as many computers as you like, as many times as you like, forever. And if I have any new indicators I add for other platforms, they'll just be added in here and you get them for free. Now, I've had many traders email in and offer me hundreds of dollars just for these indicators alone, and I'm giving them to you here as part of the complete system. You know, I've included everything to set you up for success. The only thing you could possibly still need is for me to take you by the hand personally and help you. Actually, would you like that? Would that help you if I hopped on the computer with you and showed you live how it's done and answered your questions right there on the spot? All right, well, then I'm going to give you everything, including me. That's monthly group coaching for life. Once a month, you'll get together with me personally, and we'll spend an hour together. And I'll personally walk you through the markets doing analysis with open Q&A to help you become the trader that you want to be. Now you can see that I built everything in you need to boost your trading with the RSI Power Zones. Now here's the thing. We all know the world has changed a lot just in the past year. And man, while I was just moving from Wisconsin to Texas, a lot of worldly events are happening and things feel a little unsettled, right? So while the 4 Zones RSI coverage system is designed to teach you how to fish for RSI setups, when I give you the fish, so to speak, it does aid your learning. So you're gonna love this brand new bonus that I'm revealing for the first time today. As a bonus, I'm giving you my new quick case studies. These are hot, timely, actionable updates on RSI Power Zones activity, highlighting trade setups I'm seeing instantly in multiple markets, hot off the press. These will be added to your portal with an image and description, and you'll get an email notification with every update. So the 4 Zones RSI coverage system, with the on-demand video tutorials where I take you by the hand through how to best trade with the RSI Power Zones, is valued at $1,997. The cheat sheets that you can use as a daily trading guide to learn the system faster and more easily is valued at $197. Monthly group coaching live, I mean, this is priceless, but if I had to put a price on it, this is easily $797 for just the first couple of months, because I easily charge $500 an hour for my one-on-one coaching, but you get me for life. The RSI Power Zones indicator, available for the most popular trading platforms with free updates for life, is valued at $497. Plus, you have the bonus of the quick case studies giving you hot, timely, actionable updates on RSI Power Zones activity across markets. This brings the total value to $3,488, and it's worth every penny. Now, let me ask you, if all this system did for you is help you trade an additional market this week, would it be worth it? Yes. If all the system did for you is help you finally make money trading with momentum, would it be worth it? Absolutely. If all the system did for you is help you make so much money with trading that you can quit your job, travel the world, and live the lifestyle you deserve, would it be worth the investment? Of course. The total value of the system is $3,488. Because I want to make an investment in your future, because I want you to see return on your investment fast, for a limited time, I'm making the system available for one low, easy investment of $297. You can get started now by heading to himaready.com/exclusive. And I'll make it even easier for you. When you visit himaready.com/exclusive and invest in the system today, I'm going to give you all this because I want to see you finally succeed in your trading. So I'm giving you our personal 100% satisfaction buy it back guarantee. Take action now, use the complete package for 90 days and wear the tires off the system. And if you aren't 100% satisfied with your investment, then I'll give you your money back as my gift to you. Okay, I want you to be 150% satisfied with the 4 Zones RSI coverage system. Because after all, my clients tend to stick around a long time and become my friends too. So follow the whole system. I want you to get out there and treat it like a rental car and drive it all over the place. And if you don't feel you've gotten far more than your investment, then I'll hop on the phone with you personally, work with you And what I really want is for you to be totally satisfied, and that's what we guarantee. If that still hasn't happened, then I'll give you your money back, simple as that. Again, the total value of the system is over $3,488, and I'm bonusing in this quick case studies to boost your trading faster and give you more actionable setups. And for a limited time, I'm giving each with a simple, easy investment of $297. So go ahead and take action now. You can go ahead and visit the page to sign up, and I'll show you exactly what will happen when you join us. You're going to get login details that take you to my online portal, and you're going to head into the RSI Power Zone system, where you're going to have all your training, and you're going to even have a button here that says start here. Makes it really easy to get joining, okay? And there's lots of other cool bonuses for you in the portal. So take action now, because again, this offer is special for this event here today, limited to the Traders Exclusive event. So go ahead and visit himaready.com/exclusive to take advantage of this limited time offer and get my whole system for $297. All right, I think
Awesome.
I did good with your time here, Sarah.
You did.
I saw that you gave me a little extra time.
You are perfect. This is perfect. I know we ran a little over on the first one, and I appreciate you so much that you waited. Our next speaker is on the call and ready to go. So I put your link in the chat to everyone. Now, what about somebody watching a replay of this? How's this going to work for them?
Well, they can go to the link, and if they're there when the offer's still available, they'll be able to take advantage of it. If not, they'll be directed to my team. Yeah, so better to act fast, and then we'll reach out for sure.
Awesome. Oh, thanks so much for joining us. I really appreciate having you every single time you get to come on. So have a great day, and I'll see you soon.
Okay, thanks. Take care. Bye, everyone.
Thanks. Bye-bye. All right. That was Hima Reddy, and she has her special. I've got it right up on the screen there, himaready.com/exclusive. Take a look at that. That is some phenomenal savings for a lot of good information. Now I want to introduce to you now Dr. Barry Burns with Top Dog Trading. He's going to talk to us about how to find markets that are about to make explosive moves. Now, Dr. Burns started his study of the markets under the direction of his late father, Patrick Burns, and he had accumulated 70 years of trading experience in his lifetime. So your second generation here, he's got a lot of wisdom. He probably he's probably forgot more than he knows, but just a few of his accomplishments include author of Trend Trading for Dummies, publisher Wiley, seminar presenter for several exchanges, including the CME Group and the Eurex, author of Top Dog Trading 5 Energy Methodology plugin for Metastock. He's gotten and received several years of Reader's Choice Awards for technical analysis websites and trading schools by Technical Analysis of Stocks and Commodities magazine. He's published many articles for various outlets, including eSignal Central, and he founded Top Dog Trading. And his goal is to help students shorten their learning curves in becoming traders. So, Barry, thank you for being with us. Let me just come over here and make you the presenter.
All right, thank you so much.
Do you like to prompt and talk to the audience while you're in your presentation, or do you like to hold it until the end?
Oh yeah, I like to interact.
All right, let me just come over here. I'll do one more magic thing so that you'll see the prompts. And as you know, we're running about 10 minutes over, so please feel free to go your full presentation.
All righty. Well, I appreciate that, and I will see if I can help us get back on schedule. Can't promise, but we'll see. You did such a nice introduction there for me. I could probably skip my introduction part of my presentation anyway and save a few minutes that way. So thank you for inviting me, by the way. Really appreciate the invitation. And hello, everybody. How are you? So let's go ahead and get this puppy started. So, oh, by the way, so as you do see, yes, my presentation today, the focus is how to find markets that are about to make explosive moves. I probably like you, like to make money fast and big money fast. So while this is not get rich quick, every once in a while, there are markets that set up in a certain way that provide these big explosive moves. And I'm going to teach you several of these patterns right now that I do, and I'm still doing these today. So these are current. These are working in today's markets. So here we go. First of all, yeah, I'll just go through this. I'm going to just skip this whole slide. You just gave such a nice introduction for me there that I don't need to talk about myself anymore. So blah, 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 blah. Okay. All right. Oh, I got some freebies for everybody here. So I want you to know that I give a lot to the trading community for free. I really have a great sense of contribution. You know, I've received so much from other traders, including my dad, as was mentioned, but other traders too. And so I have this great obligation to give back, pay forward, actually do both. So I have a podcast, and feel free, whatever podcast channel that you use, whether it be Google Play or iTunes, whatever, Stitcher, I don't forget all of them. But anyway, we're on all of them. Feel free to go there, pick up a lot of great tutorials on audio. Also, I've got a YouTube channel with over 200 videos, obviously, all for free. So go check that out as well. And oh, also, in the spirit of giving, I know what I'm about to say is going to make everybody really furious at me today, but unfortunately, I dropped the ball. I have nothing for sale today. Nothing for sale. I know you're just waiting to the end to see, oh, I just got your wallet open and ready, and you're ready to start, you know, flipping those dollars out. But sorry to disappoint everybody. You cannot buy anything from me today. You are forbidden from giving me any money. At the end, I'll give you some more free stuff, but it's all going to be 100% free, nothing for sale. So I apologize for dropping the ball. I know you're going to be all mad at me, but anyway. All right, on a serious note, and actually that is serious, but we've got our disclaimers here that we have to post, and I'm not going to read them, but you please do read them. And the reason I'm doing this, I know you've seen them before in a multi-speaker event like this, but it's important because people come and go during these sessions. So I still like to post it at the beginning of my presentation and understand that this is not just legalese. This is the regulators helping us by giving us the counter hype to trading. There's a lot of hype in the trading world, unfortunately, and therefore it's very important to go back. Even if you've read it before, read it again to refresh yourself and focus yourself on the realities of trading. Okay, so today, when we talk about catching big moves, we are dealing in the general subject area of cycles. And there's many different types of cycles. You got your calendar cycles. So, you know, most obvious one would be soft commodities, agriculturals, where you sow in the spring, you reap in the fall, and every year it's that same cycle based on the calendar. There's other ones as well. Then you've got your up-down cycles. This is what we're used to with when we talk about higher highs, higher lows, higher highs, higher lows in trends. That's your oscillations of the market. Order chaos cycle, people rarely talk about this, but it's a very important one. Unfortunately, I don't have time to do that today, but I have another presentation on that you might be interested in. That's about when the market goes into chaotic periods of time. And by the way, when I say the word cycle, if you're not quite clear on that, just substitute the term period of time. That's what a cycle is. It's a period of time. And there's periods of time when the markets are just chaotic, and you should not be trading during those periods of time. You need to learn how to identify a chaotic cycle or period of time. And then when the market gets orderly, and an orderly period of time would be your typical stair-step pattern, where the market just makes those higher highs, higher lows, there's accumulation, that sort of thing. Coupling, uncoupling has to do with sectors and industries. Sometimes they move together, other times they uncouple, move away from each other. When they move away from each other, those are prime times for getting into one of them. But today I'm going to talk about volatility cycles. And this is what we use to get into big moves, because volatility is the range of a market move. And again, there are cycles where a period of time where markets get really contracted and get very, very narrow range. And then after that, boom, that period of time will come when they go into wide range movements. And that's what we're looking for. So to help everybody just kind of get a visceral picture of this, So we're all on the same page here. So high volatility is where the market makes a big range and price move in a relatively short period of time. So you will have more of a vertical rectangle if you draw lines around that. All right, and then we'll go into a period of time where the market goes into more of a narrow range price movement over a larger period of time. So now the rectangle is more horizontal. So that's like your meta pattern of what we're talking about with high volatility cycle moving into a low volatility cycle. These are the best times to trade because that's where we get our big reward, best risk reward ratio. Now, what are some typical patterns to trade these volatility cycles? Well, some of the common ones that most people know are your Bollinger Band squeezes, contracting channels, wedges are good. I like wedges, triangles, and moving average convergences. Common questions are, what patterns should I trade? One of the biggest questions is, how early or late should I get into these? It's very important. Whenever we talk about cycles, timing is of paramount importance. Because again, cycles are about timing. It's kind of interesting, you know, I rarely hear people talk about timing. They talk about price all the time, which is great. You have to talk about price. But, you know, if you think about it on a chart is a two-dimensional object. You've got your y-axis, you got your x-axis, you got your price axis, and you got your time axis. And so time is 1/2 of the two-dimensional object we lovingly call a chart. So if you don't know how to time your entries, if you're not including a timing tool of some sort, you are missing out on 50% of the information represented on that chart. And since trading is all about probabilities, how can you have a high probability trade if you're not using 50% of the information on the gall darn chart? Okay. Anyway, I get off of my little rants there. Which direction to trade a breakout out of consolidation? That's always a big question. Exactly when to enter and exactly when to exit. So we're going to deal with some of these. Today, I'm going to focus on 3 patterns. Okay, so today we're going to look at moving average convergences. I'm going to kind of deep dive into each one of these for you. And then we're going to talk about triangles and how I trade them. And then for day traders, I got a special one for you. I call detachment from equilibrium. All right, so that's the intro. Now, let's get going. Oh, wait a minute. Let's check here. Janice says, oh, thank you, Festo. That's kind of you. Janice says, I'm not seeing the slides section of the webinar. Let me just ask, can other people see the slides? Are my slides showing? Want to make sure I don't keep going here if people can't see my slides. Somebody type in yes, no.
Them.
Yeah, everybody. Oh, okay, we're good. Okay, I guess it was just Janice. Oh, I see. She said she was getting disconnected a few times. Okay.
Okay.
All right, good. Just wanted to make sure I wasn't talking to myself here. All right, excelente. So let's start with moving average convergences. So what this is we use 4 moving averages. Now, these are the 4 that I use: 15 EMA, 50 SMA, 100 SMA, 200 SMA. You don't necessarily need to use these 4. If you have some other favorite ones that you use, that's great, use those. The only thing that is required is that one of them be relatively short-term and one of them be relatively long-term. That is important for this particular setup. Mathematically, it's critical, in fact. So what we're looking for here, as you can kind of probably tell by the term convergences, we're looking for these 4 moving averages to cluster together. Some people call this a coiled spring, and that's a good name for it as well. So what does that mean mathematically? It literally means, I mean, think of it, and I love to get into, you know, the literal nature of indications and everything in charts. So what these moving averages are the average of the last 15 bars, the average of the price of the last 50 bars, last average of the last 100 bars, average of the last 200 bars. So when they all cluster together close like this, that means we have had no significant price change over the last 15, 50, 100, or 200 bars. And that is one way of measuring low volatility. All right, so we wait for that. And oh, yes, by the way, let me just address this issue real quick. So you see, yes, I have a chart of Apple and it's a 3-minute chart. That is inconsequential. In other words, this doesn't just work with stocks. You can use this with Forex. You can use it with cryptocurrencies. You can use it with futures, options, obviously stocks, ETFs, really any market where you can plot price bars on a chart. So it's universal in that way. And then the time frame, again, does not matter. I've got a 3-minute chart here. Why? I don't know. Just chose it randomly. You know, if I put you could use a daily chart and the same pattern would work. If I put a daily chart up here, somebody would say, hey, does it work on a 3-minute chart? So the answer is yes, universal. All right. So what we're looking for, again, is out of this contraction, we are then looking to find a big, 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 big move. So it comes up above the moving averages, kind of stays above them, the 15 here being the shortest, kind of gets on top of the others. And then what happens next? Whoa, look out. So what's interesting about this pattern is, and this is, oh boy, this is real life trading. This is why I showed you this example, by the way, because it is not a textbook example. A textbook example that you would typically see people show you is, hey, look, we got this convergence of moving averages, and then the market just went parabolic out of this. And that all looks great when you're trying to sell stuff. But unfortunately, then when you go to trade the market, that doesn't always work out that way. In fact, it rarely works out that way. The market is not that interested in helping you or me make money. And so it does a lot of crazy stuff and isn't so nice and, again, orderly. So this is what actually happened. We did get a move up, and then we come right back down to the 15 EMA, hug that for a while, really don't get a lot of expansion. Boom, now we finally do. We're breaking the high of 1, but we run into a resistance level. And that blue resistance level is simply a previous swing high that this market now is coming back into. So people see that, they're like, oh, last time we got to this high, people didn't keep buying, so they might not this time either. This time puts in a little higher high, and now again goes a little bit above it, but I call this the flypaper phenomena, where each one of these bars still touches that resistance. Therefore, I consider that this resistance is still being held. We did not break above resistance. We pierced above it. So what's the difference between a pierce and a break? See, the dollars are in the details in trading. So a pierce is where, yes, we make a higher high, but we do not make a strong move above this high. It is basically a fake out. I don't trade breakouts. I do trade fake outs. If anything, I would want to take this short. And this is what happens. Why? Well, breakout trading doesn't work as well as it used to. You know, I've been trading for more than 50 years. When I first started trading, we didn't have computers. I literally learned trading from my dad, and then even my first mentor, by hand drawing price bars on graph paper with a pencil. Yep, I'm old. That's how old I am. Back in those days, breakouts actually worked pretty darn good. But these days, with the advent of the internet and information flowing everywhere, everybody and their parakeet knows about breakout trading. And just when everybody knows about some sort of setup, it's exactly when it stops working. So I will rarely trade a breakout anymore, but I will trade the fake out. I'll take the opposite of the popular setup. In fact, this might resonate with you. Have you ever thought that, gosh, if I just took the opposite of all my trades, I'd probably be a multimillionaire? Anybody ever think that? Just took the opposite of all my trades, I'd be successful. Anybody think that? Type that in. I'm just curious to see if any, because I used to think that. So I just want to see if I'm the only one who's had that experience along their trading journey, if I'm an anomaly, or if some of you guys have thought that as well. Let me open up the question box here a little bit. Go ahead and type it in. Don't be shy. Don't be shy. We're here live. Let's interact a little bit. You guys are so shy. Oh my gosh. Oh, there we go. Okay. Thank you, Arturo. Thank you, Festo. All right. There might be a little delay here on the webinar. Sometimes with these webinar software platforms and the different data speeds and so forth, sometimes there's a little delay. Okay. So I'm not the only one. Whew. I was scared there. I was thinking, am I a uniquely horrible trader? Did I used to be the worst guy on the planet? Okay, good. Yeah. So how I trade these now is you'll notice there's wave counts here. These are not Elliott waves. I created these in, well, for lack of a better term, since my name is Barry, I call them Barry waves. So Barry waves, you can have more than 5 Barry waves in a trend. You know, Elliott wave, an Elliott wave is fine. I've actually got a good friend who, former NFL football player, and he trades Elliott wave and he does well. And he taught me what he does, and I got it to work for me too. But I just decided for me, Elliott waves, I didn't like the constant recounting of the waves and imposing a structure on the market because they insist that a trend has 5 waves. So I'm like, you know what? The market's going to do what the market's going to do. I'm not going to impose any of my theories on it. I'm just going to count what it does because the market's not obtain a little purse puppy. The market is more like a wild animal. And so I just count what it does. So boom, okay, got one. Failed 5 is because it was a pierce but not a break. The average wave when counting Barry waves is still 5 waves, by the way, still 5 waves, but we can get 7, we can get 9. And what this does by counting waves this way, it tells us, okay, we know statistically that 5 waves is average. So, you know, the old saying, the trend is your friend until the end. Well, I want to know, when am I getting close to the end? Knowing that 5 Barry waves is the average, anything beyond that, which we allow, means that now we're getting toward the end. I don't want to buy in the direction of the trend anymore. Now, I actually look for trend reversals on wave 7 and 9. So F5 means that's a failed 5. 4 is awesome. This is where I want to buy. So I wait for the little bit of fake expansion out of contraction, let amateurs, okay, that's not going to serve them well. It makes a deep retrace, comes back down to the 100 MA, and if you look, it comes back into this contraction zone. That's what I want. I want it to fake out of there, come right back here. Now, what's happening? Psychologically, mass psychology, everybody is giving up, and they're like, oh, great. Went right back to where we started. Except now is when the surprise comes. And look at that big engulfing bar. Now, Top Dog Trading, we have unique ways of reading candlesticks. So I don't just look at a engulfing bar as a 2-bar pattern. I actually look at how many bars does that bar engulf, and it engulfs 1, 2, 3, 4, 5 bars. So that is a very strong engulfing pattern. And when I talk about engulfing, I'm talking about engulfing the real bodies of the previous bars, not necessarily the high and the low, because the real body is where the actual value was discovered during that period of time. So boom, that's what I want to see. Now we come back up to the resistance. This, by the way, is called the Top Dog Trading Rule of 3. When we hit resistance 3 times, the 3rd time is the most likely one to break through, and it sure does. And kablambo. And that's a top dog. No, that's a traditional classic technical analysis term for this type of movement, kablambo. Most people don't know that, but yeah. And then it still goes up beyond that. Okay, so most trading is counterintuitive. In fact, I wrote an article for eSignal Central, and it was called Profitable Trading Must Feel Unnatural. Why is that? Because the masses are trading. Trading is based on mass psychology, and the masses mostly lose money. And that's because they're doing what's intuitive, and what's intuitive to us as human beings is the herd instinct. So if you're doing what feels right, you are tapping into your herd instinct as a social being, and you are going to be with the masses, and the masses are usually wrong. So this is what makes trading challenging psychologically, assuming you're a human being, is that you got to go what feels unnatural. That just feels kind of, just doesn't feel right. But that is exactly what is right. Okay, so that's moving average convergences, and that's how we trade it. And you might say, well, God darn, that's not as simple as I want it to be. Yeah, that's right. And I'm here to tell you, trading is not as simple as you would like it to be. It's not as simple as I would like it to be either. But this is the way it really works in the professional world. So as my exercise partner, actually my exercise trainer, Mr. America, former Mr. America, used to say, he said, don't wish it was easier, wish you were better. And I'll tell you, I've lived by that not only in my training, but in trading and training in my whole life. Don't wish was easier, wish you were better. You got to grow into becoming a professional trader. Becoming a professional trader is one of the greatest personal growth experiences you will ever have. And you must include personal growth into your trading. Okay, let's go to pattern numero dos. It's 5, ni, de, duo. That's Korean, by the way. That's true, I'm pentalingual with the number 2. So let's go to triangles. Now again, I'm going to do this in a counterintuitive way. There's 2 traditional ways to trade triangles. One would be what's called the breakout of the bottom trend line. And the advantage of that is, well, if the market goes through the bottom trend line and the triangle breaks to the downside and it just keeps going, then you're golden. But it doesn't always do that. And so a lot of people like to trade what's called the throwback. The throwback is when the market breaks through that trend line and then comes back, usually close to the trend line, and then goes down. And that's a little safer trade and a little easier psychologically when the market doesn't break down immediately and go down parabolic. So there's pluses and minuses to each. And the people who trade the throwback technique where it breaks through and comes back, they're going to miss out if they don't get the throwback or the retrace. And they just have to say, I'm okay with that. This is the game that I'm going to play. Okay, and I'll sacrifice those clear breakouts. The breakout person, they're going to catch all of them, but they just have to be okay with when they do get the throwback, hanging in there, because now, a little bit of fear sets in, a little bit of uncertainty. Again, psychologically, it becomes a little challenging. And now it's like, oh gosh, I don't know, should I stay in? It goes down. Now, again, I am showing you very intentionally a non-textbook example. In trading courses, or whenever people are teaching you anything about trading, they do you a disservice if they only show you textbook patterns. And the reason that will hurt you is because it trains your brain. By repeating only perfect setups, it trains your brain to expect those perfect setups. And then when you get to real trading with real money and the real market and the live market on the hard edge of the screen, and these perfect setups don't occur all the time, it throws you for a psychological loop. And you get loopy. You think, hell dang, this thing didn't work. But in the book, it worked. In this guy's videos, it worked. Right. So I will show you textbook setups, but I also, whenever I teach, I also show you non-textbook setups because I want you to get your mind to get accustomed to seeing what the market really does. Okay, the reality, what you're going to see in the real market. So in this case, it goes down, comes back up, goes down, makes a lower low, comes back up, makes a higher high. Now, what if you were a throwback trader and you went short here and you can place your stop up here, you would have gotten stopped out. And this is where people say, gosh, I get stopped out all the time. So I don't like either one of those entries. Where I enter is right here. So I will go short here, trading what's called inside the triangle. Now you notice there's a commonality with the last pattern. I bought inside the zone of consolidation. I just waited for the fake breakout, waited for it to come back into consolidation, and then took the trade. So the same thing here. I'm trading before the breakout. I'm getting in early. This is a hallmark of professional traders, is that we always get in before amateurs. Before amateurs. And what that does is it, first of all, gives you a very low risk trade, but then also it means that everybody else comes in after you. And when you have all the other traders coming in after you, that's what pushes the market in your direction further and further and further, gives you those big rewards. What makes the market follow through to give you those big rewards that we're talking about today is everybody coming in after you. If you come in the middle of a move, you're going to get a smaller reward. Okay, so now the other key is, well, god darn, how do you know in real time, this was the hard red edge of the screen, how would you know that that is going to be a lower high and actually form a triangle? Because at that time, you're not really sure it's going to be a triangle, right? So what we do is we use my cycle indicator, and I don't have time to show you all of that now, but I will at the end here in just a few minutes, I will give you a recording where you can go and learn all about my cycle indicator and how to set it up on your charts, and all that's free, by the way. So using my timing indicator, my cycle indicator, it will show me when the cycle high is going to come in. And that's how I know that this will be the final swing high, and it's going to be a lower high, and therefore we do have a triangle. So I'll go short right here, and I don't have to wait through all of the stuff. My protective stop will go above this high, and it never gets close to that. I could just hang in there, and it's nothing but net. By the way, another thing with this particular setup is look at this. This is what I call concurrent setups. Concurrent setups is when you get two reasons for taking a trade at the exact same entry, exact same moment. So not only is this a triangle, but it's a head and shoulders. So left shoulder, head, right shoulder. So this is both a head and shoulders trade and a triangle trade, which gives it an even higher probability of success. And by the way, real quick, just a side note, a little helpful tip here, pro tip, a higher high and a lower high is not enough for a head and shoulders. A head and shoulders only properly comes at the end of a trend, and that's where wave counts come in again. Since we got a failed 5, now we're already into an average trend length, and therefore we can get a head and shoulders. Okay, pattern number 3, the last one as we zip through this, detachment from equilibrium. So equilibrium is defined as, first of all, you put your floor trader pivots on there, pivot point, and yesterday's close. And so the equilibrium zone is between the pivot point and yesterday's close. Okay, and so what that is some, well, it's an equilibrium point. It's very similar to the moving average contraction pattern. So we are looking for a market area that is neutral. It's a neutral zone. There's yesterday's high, there's yesterday's low. This is a neutral zone. Now again, similar pattern as we've talked about before. Market breaks below it. This is not the time I want to enter. A lot of people, in fact, I used to be taught that if the market breaks below yesterday's low, now we're in a bearish market, go short. If it breaks above yesterday's high, that's a bullish market, go long. That doesn't work so well anymore. Again, everybody knows that. So what I like to do is let it go. Again, look, it goes below yesterday's low, comes right back up. So all those people are breaking or trading the breakout of yesterday's low. Sorry. Okay, then it does it again. It's like, oh, and then people think, oh, this is the one. And it's like, psych, nope. And it comes right back into that equilibrium zone. Now I'm interested. All the fake outs have been done. All the market manipulation been done. All these short orders have been taken out. So everybody that went short, remember, I don't want to come in after they've gone short. I gotta wait. I want to wait until they're taken out so that I can come in and be one of the first ones in. And now those who want to go short, they have to come in after me. And that's what creates, guess what? An explosive move. And look how explosive that was. I just went crazy all the way down to the mid pivot between S2 and S3. Not bad, pretty good profits. So important factors in considering this. Number one, what patterns to trade? I gave you 3 today. Which direction to trade? Again, don't have time to go into the detail, but I'll just let you know. I trade these breakouts out of contraction in the direction of momentum of the higher time frame. So I'm always looking for momentum on the next higher time frame, and that's the direction that I'm going to trade. And how early or late to get in. Again, we always want to get in early, and I use my market timing indicator, my cycle indicator for that. So here's the freebies that I promised. first of all, if you want to contact me in any way, shape, form, or anytime, feel free. There's my email address, barry@topdogtrading.com. And love to communicate with traders, so don't be shy. Love to help you in any way that I can. And the free offer that I have today is a little mini course. It's 5 videos. And in those 5 videos, though, I'm going to give you something super, super practical. And that's an actual trade setup that I didn't cover today. And in this trade setup, it's called the rubber band trade, as you can see there on the slide. And the rubber band trade is a complete trade setup. So in other words, I give you everything you need with this to make money without you having to buy anything. This is the way that we work here at Top Dog Trading. We like to give value in advance, and our value in advance is we want to give you something you can make money with, like the rubber band trade. We want you to go make money with it. Then if you choose and you say, you know what, yeah, I want to buy some courses from Barry, then you can use the money you made from the rubber band trade to do that. Or you don't have to buy any courses. Totally up to you. I just figure, in today's world, it's hard to know who's right, who's wrong, who's good, who's bad. So allow me to prove myself to you before you give me, 2 bets. All right, so you get 5 little videos with this, interactive quizzes, the rubber band trade, and that cycle indicator that I mentioned, and you get it all at topdogtrading.com/free. So easy URL there, and we'll type that into the chat box and the questions box. Just go there and grab it, and it's, again, my gift to you. So let's see, I'm just typing it here into the questions box. I'll type it into the chat box as well. And I think I helped to catch us up on our schedule today.
You definitely did, sir. Just a second. Let me just, there, how about that? I also, you put in your URL. So they've gotten it a couple times. Everybody should go to topdogtrading.com/free. That's a pretty spectacular offer right there. So, Barry, thank you. Thank you for being with us today. And thank you for getting us back on track. You're fast. You're good. Always a pleasure to have you with us.
No, it's my pleasure. Thank you for the invitation, and look forward to working with you again.
I can't hear you anymore, so I wonder, did you already go?
Oh, nope, I'm here. You can't hear me? Let's see. Can you hear me now? Hello?
Okay, I got you. All right,
Okay.
Thank you so much.
Thank you.
And I just want to, let's see, I'm going to come back to me and show my screen. And again, you guys, it's https://www.topdogtrading.com/free. And that was Dr. Barry Burns with Top Dog Trading. Thank you. It's always a pleasure, Dr. Burns. We're going to bring up our next speaker, Silas Peters with Seasonal Swing Trader. He's going to talk to us about how to nail turning parts, how to nail turning points for all markets. Sorry to butcher that on you there, Silas. I just want to let you guys know that Silas has been an active trader for over 12 years, focusing on equities, commodity futures, currencies, and options. He began working on a global trading desk at the Chicago Board of Trade right out of college. He was executing trades for hedge funds, banks, institutional investors, and high net worth individuals. And in addition to working on various trade desks, managing and executing trades in the US, European, and Asian markets, he has helped build and manage several futures and equity brokerage firms. He handles day-to-day operations, trading, risk, and support. He's also worked as a private family office investment consultant and managed fixed income and equity portfolios within trust and asset management banking units. He currently holds or has held Series 3, 7, 30, 34, 65, and 66 securities and futures licenses. seasonal swing trader identifies historical seasonal trends and market cycles on up to 40 plus years of historical market data and delivers quality, actionable trade ideas that put probability in your favor. So listen up and take it away, Mr. Silas.
Hey, good afternoon, Sherry. Testing 1, 2, 3.
Let me
Do a
just,
quick audio check.
I can hear you. I'm going to make you a panelist and, a presenter.
All
And
right.
I'm going to go ahead and turn you into an organizer as well so that you can see the comments and things.
Okay, great.
Welcome. Thank you for being with us.
One moment. All right. Can you see my screen and hear me?
Yes.
All
Everybody
right.
else
Thanks
who
a lot,
can,
Sherry, for
please.
that great introduction there, and appreciate you inviting me on your show. Are we ready to go ahead and have me kick off here?
Yes, sir. Take it away.
All right. Well, thanks a lot to Sherry and the Traders Exclusive team for having me on, and I hope everybody's having a wonderful day. I know there was a lot of great speakers ahead of me, and I'm here to round it out at the end of the day here. We've got the volatility picking up in the markets again, a little bit to the downside for once, and I'm excited to show you a very simple yet effective strategy that works in all markets and all time frames. In fact, everything that I do works in all markets and all time frames. It's not just pigeonholed to one particular asset class, one time frame. So whatever it is you may do, whatever lifestyle you have, or whatever suits your trading preferences, risk tolerances, etc., this strategy will work. And I'll show you some actual trades that we've taken today and some trade setups in a live market environment here if we have some additional time. Now, during the presentation, I do want to make sure I teach you the actual strategy, get through the meat. So feel free to ask questions, provide feedback, so on and so forth. I'm going to answer your questions at the end so I can ensure that you walk away with a strategy here in the end. So let's go ahead and get started here. My name is Silas Peters from Seasonal Swing Trader. You are here to see how to nail turning points for all markets. And I want to say welcome. I know there's lots of things that you could be doing today, so I do appreciate your time and your willingness to stand here and learn an effective strategy that you can take with you and start applying immediately. Before we begin, we're going to start by reading the risk disclaimer as required by the regulatory governing bodies. Past performance is not necessarily indicative of future results. Only risk capital should be used to trade. We all know that trading future stocks, options, securities, so on and so forth, even cryptos are risky. Do not trade with money that you cannot afford to lose. Now, if you want a copy of that, hit me up at the end. I'll be happy to share this with you, but most of you are aware of the risk disclaimer and risks that are involved with trading. Now's the time we want to shut off all our distractions. It means shut everything down, close your browser tabs, log out of Facebook, Snapchat, Instagram, TikTok, put your phone on mute, hush the crying baby. We're going to be together for about 45, 50 minutes or so, and I want to make sure you listen closely and take good notes. Again, ask questions. I'll get to all the questions at the end. A little bit about me before we start here. Let me formally introduce myself. Simply put, I'm a husband, father, son. Love hanging out with the family, whether it's at the beach, on a boat, hiking, or on the golf course. I spend a lot of time working, a lot of time in front of the screen, so I like to get outside and enjoy the great outdoors when I can. So these are some pictures of myself and my two beautiful daughters and my wife, even my dog here photobombing, just to show you that I am a real human being and not a robot. And I do like to hang out, certainly when I can. But how did I get here? Get here where I have the privilege of speaking to you today? Well, in college, I majored in investment finance and economics. That's all good and great, but I had no idea where that was going to send or land me. Fortunately, one of my dad's golfing buddies used to be an ex-wheat trader in the grain pits of Chicago. And we were playing one day. He was asking me what I was going to do, what my plans were. And of course, I had no clue, had no idea what I was going to do. Well, he was telling me about his experiences, his life in Chicago, trading, the pits, commodities, and what happened. I was immediately intrigued. I went back to school, started doing some research on Chicago, the trading floors, trading in general. And then what happened? Well, Needless to say, I was a bit green on the sleeve when I sold my car 3 days after I graduated, rented a U-Haul, and I drove to my new digs in downtown Chicago, signing a lease right here in the Honeycomb Towers, also known as Marina City, overlooking the beautiful Chicago River. It was directly above Smith & Wollensky Steakhouse, House of Blues, Harry Carey Steakhouse. It was right about a block back. Had a wonderful time there, wonderful time. And actually, the same day I moved in, I took the U-Haul truck back to this depot, hopped on an Amtrak, and I scalped a couple of tickets to the U.S. Open at Olympia Fields in Wisconsin. So back to my journey or my career path. My first career until this, and I want you to picture this. I was working the Asian, European, and New York session trade desk. And if you remember me telling you I sold my car, well, this picture right here could literally be me walking to work at some time around 6 a.m., 6 p.m., 2 a.m., or if I got off early, maybe 4 a.m. And I remember on numerous occasions me walking down the middle of LaSalle Street right here, nobody but me and a snowblower in the entire city of Chicago, looking up at the great Chicago Board of Trade with the God of Grains or Ceres looking down upon me, getting into the Board of Trade and the temperature reading a solid negative something degrees. Now, I remember when if we got into the teens, it was like a godsend of warmth. I am from deep South Alabama here on the Gulf Coast. All I know is heat and humidity, so that was quite a wake-up call. So I did this right here for a few years, working at the Board of Trade, handling some serious trade size across the Board of Trade, the Merck, NIBOT, NYMEX, various London and Asian exchanges, trading for our hedge fund, banks, CTAs, everything from corn to copper to hogs, euro dollars, and Japanese government bonds. It was an incredible learning experience, both with the markets and trading, as well as the Chicago big city life. But I decided to head back south when some other opportunities opened up. And that's when I went truly corporate. I went from a fast-paced and somewhat stressful hedge fund trade desk to a more slower-paced life, managing equity and fixed income portfolios and other investment management roles in this glass building right here. And to me, it was extremely boring, but it was the safe route. But I missed the action and the excitement of the pits, the tape, the screens. So through some additional contacts, I was led to a day trade firm where I helped run operations, execution, and trading education, to then running a couple of futures brokerage firms, and then ultimately working in a private family office, serving ultra high net worth individuals, doing a hodgepodge of all these items. So it's safe to say I've seen a lot of spectrum in the finance world, but honestly, I was just not that happy. I still miss trading and the trading world. Me sitting in an office tied to a desk, looking out the window, and of course, dealing with your typical corporate red tape was just not in my blood. I wanted to get back to the markets, to the charts, and to the trading. And while I was still trading during this time, I missed being in the weeds of the markets, following the charts, doing the analysis, and so on. So I left the corporate world and I started Seasonal Swing Trader. It's here where I publish research, ideas, and analysis to my followers, and it holds myself and our community accountable each and every day. But during this entire journey, there were certainly some painful lessons to be learned. I grew accounts, blew accounts, grew accounts, blew accounts. I was not a trading god. I was not above the market. The market didn't care what my position was, and it damn sure didn't care about my opinion or what I thought it should do. So what does that mean? Blown accounts, emotional trading, acting like a gunslinger, and poor risk management. But these are all battle scars. And in this workshop, I'm going to attempt to help you think smart, think logical with a proven price action strategy and plan, so you can avoid the many mistakes that I, and I'm sure several of you, have made or are making today. But let's talk about you. Why are you here? Why are you here? You're here to have or learn a reliable pattern for all market conditions, to have a strategy for all asset classes, and to be agnostic of market bias. In today's markets, it's imperative to make certain we have a strategy that can trade both ways. We need to employ strategies that can profit during up markets, down markets, and sideways markets, and do also without guessing. So today, I'm going to show you a pattern that results in trend reversals, show you the point where a trend is likely to reverse, and show you a pattern with the least risk and highest reward. So does everybody want to see this? That sound good? All right, excellent. So are you ready to learn a strategy that is not only low risk, high reward, but also works in all markets, time frames, asset classes, and market conditions? Like I said earlier, I'm not going to sit here and teach you a strategy that only works on a 1-minute Bitcoin chart or a weekly Facebook chart or a 4-hour crude chart. I want to show you a simple and straightforward strategy that works in any market, any condition, ranging, consolidation, contraction, expansion, low vol, high vol, etc. And I don't care if you're a tick trader, scalper, day trader, swing, or position trader. If you trade the underlying, you trade debit spreads, credit spreads, iron condors, butterflies, I don't care. What I'm going to show you is powerful, and I'm going to actually prove it to you. Before we continue, it's important that we cover the process. Has anyone here heard of Jesse Livermore? Anybody here? I encourage you to read, if you have not, to read Reminiscences of a Stock Operator. If you ever get a chance, you probably get a used copy on Amazon for about $5. A question I often receive is, what do you think about the markets here, Silas? And my typical response is, I don't know, and I don't care. And I know that sounds maybe a bit harsh, maybe it sounds ill-informed, especially when you're asked by friends or family members, but it's true. For the most part, I really don't care about the daily news that flow in and out of the market. I'm a trader that trades strategies based off probabilities. So when we forget about market assumptions and only focus and trade with high probability strategies and what is in front of us, and that means no more predicting. So as successful traders, we know that they possess 3 common traits. It's about your strategy, your logic, and your process. Knowing what is going on in the news and knowing how to make money consistently are 2 separate things. It doesn't matter what you think the market is going to do tomorrow. And I know it's a difficult concept for maybe new traders to understand, or even seasoned traders may struggle. I certainly want to form my own opinion as well. It's just human nature. But it took me years to figure this out. It doesn't pay for me to try to absorb every financial story out there or slap every indicator onto a chart. All I care about is when the markets I am following reach key criteria. But there is one more trait. Because if we allow probabilities and not talking heads to define our next move, we need to really possess and control one more trait, and that is patience. Because smart traders know that trades should never be forced, because a forced trade is not a statistically sound trade. Again, we're in this for the long game, and patience is expected if we wish to bring in profits over the long term. I know that may sound boring to the aggressive crowd out there, but I'm more interested in the profitable trades, not trying to be a short-term hero who tries to trade every scenario out there. I'm confident in trades that consist of key criteria that are setting up, and we're talking about extremely high probability trades. But patience is the key ingredient to the success of this strategy, and I can't emphasize that enough. So what is a high probability strategy? Well, it's one that requires patience coupled with a disciplined approach, waiting for the appropriate scenario to unfold with a high probability of success is what makes this strategy a success. It also recognizes that opportunities are made up easier than losses. So if we let a few pass us by, we don't dwell on what could have been. There's always going to be more opportunities around the corner. And then lastly, I realize that the less I trade, the better my strategy will likely perform over the long run. And the long term is what matters. This likelihood is what makes my high probability strategy unique and successful. But the grand takeaway here is patience. Patience pays in this game. So Silas, what indicators do I use to successfully trade high probability strategies? What is the secret sauce? What are the ingredients? Well, we talked about one, and that is patience. But I learned early on to keep it simple. Pick a few indicators and try to follow them for as long as you can. I can't tell you how many people approach me each day that have Donchian channels, market profile, Gann, Bollinger Bands, Fib retracements, and the list goes on and on. And these are all in the same chart, and that clouds the chart where you can't even read the price. There's nothing wrong with that. Nothing wrong with that. But This high probability strategy uses price action alone plus one very common and free basic indicator, along with a couple of pro tips to take advantage of sentiment and technical extremes. So who here has seen Jerry Maguire? I suspect a lot of you have. Love it or hate it, this is a famous line. And I'm not going to show you the money because I don't know how you trade, but I will show you the opportunity. So let's get to it. It's divergence. Wow, what a brand new concept, right? No, of course not. Who here has heard of divergence? So before those that start getting, and I'm not saying anybody is, but if you have a negative connotation about divergence, oh, I've heard this is nothing new, this is subjective, so on and so forth. Well, I'll challenge you to stay around to see how we use it to find high probability trades. So let's quickly talk about it, and we're going to go through several examples. Divergence is when the price of an asset is moving in the opposite direction of a technical indicator, such as an oscillator, or moving contrary to other data. Divergence warns us that the current price of the trend may be weakening, and in some cases may lead to price changing direction. So basically, it's an indicator in price action being in disagreement, using any relevant indicator such as MACD, RSI, so on, and it's an indication of a reversal or a continuation, but more often a reversal. Now, what is it? It can occur between the price of an asset and almost any technical or fundamental indicator or data. It's typically used by traders when the price is moving in the opposite direction of a technical indicator. Okay? Now, the details. Positive divergence occurs when the price is moving lower, but a technical indicator is moving higher or showing bullish signals. Negative divergence occurs when the price is moving higher, but a technical indicator is moving lower or showing bearish signals. Why is it important? Because it is the earliest indication of a reversal, a good sign to exit, a good sign to scale, and it means that we're usually buying near the bottom or selling near the top. Let's talk about the types. We first have classic, or sometimes called regular bullish and bearish. Bullish divergence is when price action makes a flat bottom or lower low and higher low on the oscillator. Bearish divergence is when price action makes a flat top or higher high but lower high on the oscillator. Traders use divergence to assess the underlying momentum on the price of an asset and for assessing the likelihood of a price reversal. So if the market is making new highs, but your RSI is making lower lows, this warns us that the price of the uptrend may be weakening. It's negative divergence. Positive divergence is the opposite situation. Imagine the price of a stock making new lows, while the RSI makes higher lows with each swing in the stock price. Traders would then conclude that the lower lows in the price are losing its downward momentum and a trend reversal may soon follow. We also have what we call hidden bullish and bearish divergence. Hidden bullish div is when price action makes higher lows but lower lows on the oscillator. That's what we normally see in an uptrend. Hidden bearish is when price action makes higher lows and higher highs on the oscillator, and that's normally what we see in a downtrend. Hidden bearish tells us that the oscillator is possibly creating space to go back down again, or could be the continuation of a downtrend. So let's quickly talk about regular divergences, and this is an example of regular bullish. It's the most frequent and considered a sign of a reversal. The price is making lower lows, but our oscillator is making higher lows. The price is making low, lower low, oscillator low, higher low. We don't necessarily need a series of lower lows, only one low to be lower than the previous low, and it can usually be found near bottoms. Hidden bullish divergence is a trend following type when that price is making higher lows, low, higher low, but our oscillator is making lower lows, low, lower low. That can be seen when the price is in an uptrend and indicates that the price may tend to go higher. Regular bearish is the most frequent, usually considered a sign of a trend reversal if the price is making higher highs, high, higher high, but our oscillator is making lower highs, high, lower high. And it can be found near tops. And then hidden bearish is another trend following type. The price is making lower highs, but the oscillator is making higher highs. This can typically be seen when the price is in a downtrend and indicates that the price may continue lower. Now let's talk about identifying strength and consider the following scheme here. At point 1, Buyers believe that the trend has recovered, or at least a new trend has begun, and they want to make money. So they start opening up long positions, buying the market, and it drives the price higher. The trend accelerates as more and more buyers are jumping into the market. At point 2, buyers start to take profits, and then the trend begins to weaken. Buyers still dominate, but they calm down because they're afraid that the trend is coming to an end. Then we get to point 3. There's no more buyers in the market. Sellers step in, they begin to dominate, and the trend actually changes and reverses. And we can use tools to help recognize trend and trend strength, and one of those can be found with the popular RSI. I think the standard rule of thumb is, if you will, when RSI rises above 70, the market's considered to be overbought. When the RSI falls below 30, the market's considered to be oversold. That's a great concept, but we want to use the RSI in a slightly different way. Now let's talk, whoops. So let's take a look. Look at the same chart that we just covered. There's 2 significant highs labeled A and B in the price chart, as well as in the corresponding RSI pane below, A and B. Price chart, we see that B is higher than A. That means the price is still going higher. And the RSI pane below is just the opposite. B is lower than A. It means the trend has weakened and is likely to reverse. And lo and behold, what happened? We got a large bearish candle, the market sold off, and it reversed in quick fashion. Now, we use the RSI in the previous example, but it can be replaced with any momentum indicator, such as CCI, stochastic, MACD. All of these indicators are derived from price, so there's no better or worse indicator. It's really about preference. It doesn't matter what indicator we call our best friend. Every approach is good, but let's go back and focus on what matters, which is the concept of divergence. Before we get into the thick of it with additional charts, let's quickly recap for context before we take a deeper dive. So bullish divergence is when price makes 2 significant lows, but the second is lower, and the RSI makes 2 significant lows, but the second is higher. Bearish divergence is when price makes 2 significant highs, but the second is higher, and the RSI makes 2 significant highs, but the second is lower. So we previously defined divergence as a discrepancy between price and indicator movement. Note we've now added the MACD to the chart. When the price makes a new low, but the MACD makes a higher low, we have bullish divergence, signaling that the trend is likely to reverse. This is classic or regular divergence. The black line on the price is sloping down. The black line on the MACD indicator is sloping up. Now, the depth of divergence is a bit more of a subjective term. When you look at this example, we see 2 div patterns, a bullish and a bearish. The first divergence is nice, but the second one does not look as promising because the 2 peaks or troughs on the MACD are not very significant. We consider a divergence to be deep if the MACD crosses the 0 line. Such a divergence provides a much stronger signal for trend reversals. On this chart, we see 2 div patterns. The first example is an almost double bottom, if you will. The second example has more defined peaking action. When we peak, the MACD line crosses the 0 line, rises back up, forms a second peak, which is lower than the first, thus giving us our divergence pattern. And because it did cross the 0 line, this means that it is a higher quality div pattern. So now that we know the basics of divergence, let's look at ways we can approach them in a smart and methodical manner. We've discovered that these patterns can lead to consolidation, correction, or full trend reversals, and that's great, but we need a plan, a definitive plan about where to enter, where to place stop losses, and where to exit. Because with this strategy, we can make quick profits on small corrections or minor trend reversals, or we can try and capture major market moves. And when the trend reverses, it's every trader's goal to try and stay with the trend for as long as possible. Now, we know that divergence is a very reliable pattern. Sometimes chart pattern traders see a double top. Elliott wave traders may see a short 5th wave, but they all refer to the same thing, divergence. This is what chart pattern traders see. This is what Elliott wave traders see. And this is what we see. Excuse me. Most traders don't realize that MACD or RSI divergence is exactly what they're looking for. Our approach removes the subjectivity because the div pattern is well defined. So now let's talk about entry. Now let's look at this into even greater detail. So the first is entry. Where or how do we even enter these trades? There's a couple different ways to consider entries, and one, that is a simple enter on next candle open rule. So we wait for the divergence candle to close, and then we enter on the next bar or candle open. Another method is to wait for candlestick confirmation. That is, we wait for a bearish candlestick, either an engulfing or reversal pattern for short positions, or a bullish candlestick to open up and establish long positions. So we talked about entry. We need to now talk about the least fun or exciting aspect of trading, but by far the most important, and that is stop losses or risk management. Now, there are literally, dozens of different ways we can use stops or manage risk, but let's keep things simple and objective. For a stop loss with this strategy, we can place a stop just below the bullish divergence pattern for a long minus a few ticks, pips, or points as a buffer, or just above the bearish divergence pattern plus a few ticks, pips, or points for as a buffer. We'll talk about that a little bit later. In this example, we see that the second turning point or the point of divergence can act as minor resistance from which price uses to retrace, and we are thus protected from being stopped out too soon. So now we've covered entry and we've covered stop losses. Let's get to the fun part of trading, and that is profit taking or targets. Now, our first goal is to make a profit before the market turns against us. And we don't need to shoot for the moon here, so we don't want to place the profit target too far. I found in my trading and back testing, a wise place to place the profit target are at significant areas of support and resistance, or what I like to call price structure. This keeps us from guessing an arbitrary amount of ticks, pips, or points. The divergence valley is a good place for profit taking. Notice that we have very clear price structure at these levels, and prices are likely to gravitate towards that area like a magnet. Let's look at an example. It's no coincidence that prices have reaction at these levels. So by taking profits here, we can profit from div patterns that result in minor trend changes or corrections, and we can make consistent profits based purely on this exit technique alone. But divergence, as we know, can also lead to complete trend reversals, and we want to take advantage of those trends that can occur, which we'll cover in just a bit. So candles, when a candlestick reversal pattern or an opposite div pattern appears, it can serve as a good place to exit. These important reversal patterns can signal that the trend is likely to reverse or at a bare minimum pause. So if we see a candlestick reversal pattern that appears close to our first take profit objective, but we weren't filled, it means that prices could potentially reverse, and we want to close out partial positions here and not wait until the price comes back to the take profit level. Let's look at this example. Here we can see, here's our entry order right here. Price lurched all the way up to the valley or take profit area, but put in a bearish reversal candle and then sold off. Price retraced a bit back higher, came to that second level again, but reversed again. But this time drifted all the way to the stop out area. So that's why it's usually a good idea to consider closing part of our position here. Now, another great way to trade the strategy is to add a couple of moving averages to your chart. It doesn't matter which ones you choose, but I've got an 8 and 34. The 8 is the fast or the green one, and the 34 is the slow or the red EMA. And the first look at this example shows that the candlestick reversal right here in the middle of the chart was a solid place to exit. And look, I'm not complaining. If we're shorting here, taking profits here, and then we're reversing here, or we're closing our trade, I'm not complaining, but there is room for improvement. When we add that 8 and 34, notice that we were stopped from our shorts by this candle correction, but then the trade continues. When the price bounced from the slow EMA, we have a chance to re-enter the market and continue to ride the trade lower into profit, all by stair-stepping our stops above swing highs along the way. So now you've seen a few examples of how to catch the quick move happening after divergences. The most popular approach amongst traders that I see is they exit a certain number of ticks or points or pips. But to me, that's the wrong way. As you know, every market and every time frame have different volatility components. So it makes no sense to go for an arbitrary 100 pips or 5 points on the S&P or $7 on a stock, because volatility changes over time, and it changes over time for each instrument. So the best way to determine our exits is by testing the strategy and learning the individual market's movement or rhythm. Yes, you can certainly do that, but there's an easier, less objective way. So let's quickly recap a few strategies that work best for these setups. 1, structure. Plain vanilla structure, values and dips at significant areas of support and resistance. Candlesticks. If we have a reversal pattern that appears close to our take profit levels, but we were not filled, close part of your position, move your stops to break even, and let it play out, okay? All right, so now let's talk about false divergences. We know we're gonna have false setups just like there are in any strategy, but how do we filter them? But we know that when traders are trying to jump in a new trend, they typically want some confirmation. And we know that a trend reversal can be confirmed when we have a divergence breakout. And to many traders, that divergence is confirmed when minor support or resistance is broken. There's nothing wrong with this approach, but with such approach, the entry can be too far away from the start of the move, and the risk can be too high when compared to our reward. Remember, our goal is to limit risk. So this is where most traders are looking to enter, but we're looking to take a profit. We're looking to enter here, take profit here. We're looking to enter here, take profit here, as opposed to enter here. And this entry technique is not wrong by any means, but there is a better approach. Now, I also want to remind you that sometimes the MACD histogram can look choppy, quickly reversing up and down, implying that the market is in chop zone. And that can generate a long series of false divergence signals. So those of you that are looking for some holy grail chop zone indicator, this is it. And it's called the MACD, and it's free on every platform. We can easily see markets in chop zone, trend, chop, trend, chop, trend. Add the MACD, and you can quickly see, if you can't already tell by looking at the price action, if the market is in chop or trend mode. All right. So to prevent overtrading, I found a way to recognize clear div patterns. The gold rule says that the signal line must be crossed by the 2 peaks. Look at chart 1 on the left. You see how the signal line crosses the 0 line? We peak, cross the 0 line, peak again. But on chart 2, there's no crossing of the 0 line. We have peak, 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 but no crossing of the 0 line. So this is going to be your higher probability pattern. And now back to entries. Remember, our goal is to enter as soon as possible after the div pattern has formed. Our strategy gives a signal just after the MACD hook or the turning point. Only after that MACD hook is formed, you'll recognize the second peak on the MACD histogram. And this is where we recommend to enter on the next candle open. A very simple and mechanical rule. But I further fine-tuned this into an even more reliable method, and that's by using trend lines. Experiences show that trend lines can be used as a great confirmation tool for any trading strategy. So when looking for a long signal, we can draw a trend line on the chart by connecting the minor highs, placing a buy stop order just over the trend line. When looking for a short signal, we draw a trend line on the chart by connecting the minor lows, place a sell stop just below the trend line. When the price breaks the trend line, we are in. This entry is almost the same as the quick entry on the next candle open technique, but sometimes protects us from the false MACD hook when the MACD turns again and continues to fall. A bit more discretionary, but it's an effective way to enter on these signals. Here's another example, but this time to the sell side. We place a small trend line on the chart. We can enter on a sell stop or confirmation retest of that trend line break, and boom, we are in the market. So let's recap everything you've learned so far. You've learned a high probability reversal strategy. You've learned where to enter, where to place risk, where to take profits, and how to filter false setups. But have you ever wondered why the market turns against you when you jump on a promising looking trend? The most tempting signals are usually a trap. As there are no more buyers to move the market, the sellers begin to dominate. As there are no more sellers to move the market, the buyers begin to dominate. Divergence masters know how to enter in the opposite direction just before the trend turns. So this is a quote I love by Max Gunther of the Zurich Axioms. Yes, following the herd may work sometime. 90s tech bubble worked until it didn't. 2000s real estate boom worked until it didn't. Crypto mania of the 2010s. But do you really want to be the one chasing new highs when you have a high probability of selling them, or panicking at market lows when you could possibly be buying at substantial discounts with much lower risk? Of course you do, if you want to be a profitable trader at least. So when you trade this way, our winning batting average could be sub 50%. Yes, you don't have to be right 50% of the time, even 40% of the time, when your risk to reward is overwhelmingly skewed in your favor. But here are some additional pearls of wisdom. The less you trade, the more successful you'll likely be. You want to filter the unreliable patterns and focus only on the strongest signals. Use a customizable indicator that can deal with this for us, where the process of recognize the pattern in the chart is done for us automatically. And we sit back and enjoy the various exit levels and find out what suits our trading style the best. So how do you do all this? Well, it depends on your style of trading, but you can scalp on tick or 1 minute charts. You can look for intermediate trend changes on the hourly, or trade longer term on daily, weekly, and monthly. Trade any asset class, any markets that you wish, but you've got to be patient. You got to avoid over trading, because remember, patience pays in this game. But how? Silas, there's too many markets, too many time frames. I don't have enough time. Well, look, I am in the same boat. We're all scrambling and scratching for time in our busy lives. Well, we've now developed a time-saving solution so that traders can live their lives, not worrying about scouring through thousands of symbols, dozens of time frames, scrutinizing hundreds of charts, trying to determine if what they're eyeballing is actually divergence or not. We've cracked the code and simplified the process. But I've got to ask, who here is ready to trade like a professional and stand out from the crowd? Let me take a swig of water here. Let me see who's on board. Absolutely. Otherwise, you probably would be here wasting your time. Well, I'm pleased to introduce Divergence Dominator Pro, because it's time to automate. DD Pro is a fully complete, comprehensive trading business in a box solution. So let me quickly guide you through what this package is so you can immediately see how it will benefit your trading starting as early as today. What is it? What the heck is this? What all do you get? It's a great question. Well, you're going to get the turning point identifier indicator, what I call the TPI, the DD Pro scanner, price action pro trading course, candlestick recognizer guide, divergence cheat sheet, DD Pro trade journal, and the fast slow line cheat sheet. So let me show you exactly what all this means. The turning point identifier indicator auto plots divergence setups on our behalf, scanning the market to locate across multiple markets and time frames for key turning points. Let's see what this bad boy looks like. And everybody see the charts. This is a daily chart of IBM. You can see a bullish divergence line followed by a bullish divergence buy signal. Bearish divergence line followed by a bearish divergence sell signal. Here is a daily chart on the Japanese yen. Bullish divergence buy signal, bullish divergence buy. Bearish divergence line, bearish divergence sell signal, bullish divergence line, bullish divergence buy signal, and so on. Here's a 5-minute chart of the E-minis. Bullish divergence buy signal, bearish divergence sell signal, and the list goes on. You attach this to your favorite charts, regardless of the market. Platforms. How about Thinkorswim, TradeStation, NinjaTrader 8, TradingView, and MetaTrader 4? You pull up your platform, attach the TPI to the chart, and immediately begin to see turning points, i.e. divergence, in real time. But we don't want to have to locate these manually, right? Of course not. If you've been trading for some time, you know that these patterns are probably some of the most reliable and profitable setups for trading reversals. But here's the thing, manually identifying these are difficult, they're time consuming, especially when you're analyzing multiple markets and time frames. If you're focused on one market, a daily chart of Caterpillar, well, you probably don't need it because you'll be able to spot and analyze that all day long. But if you're wanting to diversify your trading opportunities, trade some short term, trade some intermediate, trade some long term, trade across futures, currencies, stocks, whatever, you need a scanner to help locate these for you. And that's where the scanner comes into play. Now combined, the TPI indicator and scanner are capable of identifying divergences using all asset classes, time frames, chart types, for scalpers, day traders, swing traders, and position traders. But aside from the indicator scanner, I really feel the crown jewel of this package is my Price Action Pro Trading course. This is a 10-part on-demand video module course covering all of these key setups. This is a to Z training course focused on trading pure price action, how to find and identify the most important areas to even consider being a buyer or seller, completely remove the uncertainty, all by trading in conjunction with the TPI. So do you want to quit guessing? Do you want to feel confident about your entries? Remove your emotions, begin to think like a professional, immediately scale your reward versus risk, have a solid trading plan? If the answer is yes, well, you get the TPI indicator for all 5 platforms, the scanner for 3, but it's important that it help jumpstart your success even further. Because you see, this is really no big secret. In fact, divergence has been known and used for decades, but now not only do you get a first of its kind tool, an indicator that locates high probability turning points on your behalf, the PAP course has all of the solutions to help you with each and every one of these bullets. PAP can help solve these problems in a comprehensive step-by-step on-demand video module course that can be viewed over and over again at your viewing convenience. Next, you're also going to get the candlestick recognizer guide. This is not some lame, just general guide on candlesticks that we all know about. We know there are dozens of formations and patterns out there, but this one is short and sweet and only covers the most important patterns that you should focus on. Another incredible bonus is the divergence cheat sheet that you can also download and print. This is great for those like written descriptions and summaries that can accompany all of the video modules. You're going to learn about regular div, hidden div, exaggerated div, the differences between each, and additional trading tips. So with the Divergence Dominator Pro, you're going to get the TPI identifier indicator, the DD Pro scanner, the candlestick recognizer guide, divergence cheat sheet, the journal, fast slow line cheat sheet, and much, much more. What is all this worth to you? If you're now able to profit in any market condition, if you can anticipate major market reversals and turning points, if you could trade on your time, regardless of your style, if you had all of the tools, an indicator, scanner, videos, training guides, and access to me, direct access to me, what would that be worth to you? But we've got to determine if it's a fit. If you like scalping on nanosecond charts from dusk till dawn, getting stressed out and having heart palpitations, you get a thrill of blowing out accounts, driving to your bank and wiring money over and over again. If you have a gambling mindset and have no clue where the market is likely headed, this is probably not for you. And if that's the case, there's no hard feelings. I wish you the best of luck in your trading endeavors. But if you're ready to think like a professional, you're ready to remove your gambling mindset, you're ready to get serious and treat trading like a business that it is, and you're ready to kick your emotions and have confidence, I cannot tell you how important it is when you have confidence, when you go to put your hand on that mouse and pull that trading trigger, then all this can be for you if either of these fit. Now, the Divergence Dominator Pro package The scanner, the PAP course, cheat sheets, and other guides have a real world value of $4,427. But I'm very proud of this indicator. The PAP course, all the other material, I want to get this out to those that are serious, those that are tired of kicking the tires, those that are sick of jumping from system to system, and those that are ready to take action to see some real results in their account. We're not going to charge $4,427. I'm going to charge $3,000 or even $2,000. We're not even going to charge $997. As part of this live webinar special with Traders Exclusive, we're pleased to offer this to the first 15 signups, a one-time single payment of $397. Offer link is seasonalswingtrader.com/pro, and I'll try to put that into the chat for you. I'm going to answer all of your questions here. I've got a lot of good ones. Okay, I just put that into the, oops, sorry about that, guys. Put that into the panel for you. Okay,
I got
thank
you.
Yeah, appreciate that. So link is seasonalswingtrader.com/pro. It's almost 90% off the $4,400 value. You need the indicator suite, the scanner set, PAP course guides and cheat sheets for a very low one-time fee. You own it for life, get it for all platforms. Now, one thing I want to go over, because I get this a lot. Silas, how do you trade these setups? Well, the easy answer is that it depends on the setup. Depends on the outlook, shorter to intermediate to more position-based. What other positions do I have on? And the risk-reward ratio of that particular setup. But how do I physically trade them? Trade credit spreads on equities. I'll trade credit spreads on commodities as well. And I'll also trade the underlying in both futures and FX. But let me say that what or how I trade really does not matter. You should never be concerned with what I'm doing or what Susie or Billy or Bobby or Frankie are doing. If you have a question or idea, shoot it to me. I'll answer you all day long. In the end, you are in control of your own account, how much capital you have, your knowledge, risk tolerance, and time you can personally commit. So here's the offer link again. I want to get to some questions. I also want to show you the members area if I've got some time. I think I've run over just by a few minutes, or maybe I have an extra few minutes. So let me pull over. I like to show people the members area. If you're like me, you want to see what you're getting into. So here's your indicator. So yes, I already see some questions about what indicator do I get. You get access to all of them. And yes, you can load them on all platforms at once if you wish. I doubt you'll need that, but for me, I've got them on 2 computers right now. On this PC I'm on, over to my left, I'm on a laptop where I've got it loaded on another computer. So here is the scanner, your installation guides. You come down here, here's all of the modules. So this to me, you know, it really is a golden area to focus on. You can knock this out, you know, in a day, less than a day. It's not going to take you months or weeks to even go through. But whether or not you choose to use divergence or the indicator you're trading, this is the core principles of trading: price action trading with structure. Here's all of your other bonuses and material down here, analyzing for day trading, swing trading, your journal, and cheat sheets and guides and so forth. Okay. Let me see here. Yes, you can use PayPal. I think there is a PayPal link on the form. Let me check. Yes, there is PayPal link on the form. So just use that right there if you want to pay with PayPal. My email is support@seasonalswingtrader.com if you have any questions. This is not a subscription or a renewal. This is a one-time fee. Any enhancements that we do, upgrades, I don't anticipate any, but if we decide to do so, you will get access. You'll access at no charge. How often do the signals appear? Great question. Couldn't tell you. Depends on the market. Depends on the market. and if the market is moving, but markets are always moving. There's always a market moving. There's always different time frames. Let me show you the example here. So you may have seen, real quick before I wrap up, that you have maybe a regular version and a version 2.0. Well, this is version 1, our original version. Let me move this up. So here on this daily chart of Halliburton, you see our my bullish divergence line with a bullish buy signal. Now what we did is we added a different version, and I'm going to show you what that looks like. So this is what 2.0 looks like. It's the same signal, same setup, but now it plots onto the price chart with an actual buy or sell signal onto the chart. And you see these lines here? These lines this is the entry line, this is your risk line, this is TP1, and this is TP2. And these can all be edited. These variables can all be edited by you, the user. So our risk level is an ATR multiplier. If you remember me telling you about, we wouldn't want to program, let's put a $5 stop on every stock. Oh, it makes sense. You know that Tesla moves different from Halliburton, you know, or the mini NASDAQ moves differently from 30-year bonds and so on. So the stop loss is based off an ATR multiplier of that market in that time frame. So if the ATR for that stock is 2 and your ATR multiplier is 1.5, it's going to be 3.5. And your profit targets, you have the option to display either 1 or 2. And that's going to also be off an ATR multiplier. So this is right now, this is 2 times ATR multiplier. This is 3 times. You want the ATR, you want your profit ATR to be greater than your risk ATR. Let me see. Yeah, you can absolutely monitor different markets on different time frames at the same time. Absolutely. All day, every day. If you suck at technology, you can email us at support@seasonalswingtrader.com. My tech guy can even do a remote session with you to help you get up and loaded. I think I am past my time here, Sherry, so I want to, I guess, turn it back over to you. If I miss any questions, reach out to me. Thank you so much for having me on the show, and you had a lot of great speakers. I wish everybody the best of luck in trading and in health. Take care, and we'll talk soon.
Thanks so much for being with us today. That was fantastic. Let me just see if I can bring it over to, I wanted you guys to see the seasonalswingtrader.com/pro, and you can get in touch with Silas there. And that is an amazing offer as well. I'm always so thrilled with the offers that our speakers bring to the table for our viewers. And that is going to wrap us up for today. We do have our next webinar will be on September 8th. And I would just like to say thank you to our presenters for joining us today, and thank everyone out there for attending. And this is your host, Sherry, saying trade well.